Welcome to Yahoo Finance Live. Happy Friday. I'm Julie Hyman with Brad Smith. Let's get right to the three things you need to know to start your morning. First thing you need to know, mixed economic data at the same time that Fed officials are signaling at least one more rate increase at their meeting in 2 weeks. I got the Friday giggles. You're making it worse. Cleveland Fed President Loretta Mester told Yahoo Finance in an exclusive interview that she thinks rates will have to go above 5%, echoing other central bank members. That's as data including existing home sales, building permits, leading economic indicators, all of them trailing estimates. Today we get an early read on April with the Purchasing Managers Index. Second thing you need to know, Procter Gamble beat on earnings and revenue in the third quarter. It did report lower sales volumes in some of its divisions. Its grooming, home care, and family care segments dropped, while beauty and healthcare volume both rose by 1%. The company also raised its sales growth outlook for the fiscal year as it remains confident that it can bear through inflation woes and other headwinds. And third thing you need to know, both Clorox and Whole Foods announced job cuts as more layoffs bleed into corporate America. Clorox announced it's laying off about 200 workers as part of its ongoing restructuring effort. This is the company's second round of reductions. Last year, it cut about 100 jobs. And Whole Foods is planning to cut several hundred corporate roles. That's according to the Wall Street Journal. The Amazon-owned grocer will trim its regional operations from 9 to 6, but it's not closing any stores or facilities.
We heard a lot of Fed speak this week, with the Fed officials backing another interest rate hike as they continue to monitor any uncertainty in the banking sector. Yahoo Finance's Jennifer Schonberger spoke with Cleveland Fed President Loretta Mester in an exclusive interview about the state of the economy and inflation. Take a listen.
I do think that given where inflation is, and given how stubborn it is, and given the strength, the still strong labor market, I do think that rates are going to have to move up to above that 5% level. But how much they have to move up and for how long they'll have to remain there, that's what the economy is going to tell us. The economic developments, financial developments, those developments are going to inform, right, the future path of policy.
And so right now, as far as the expectation for that future path of policy, if you ask any of the bank CEOs that have reported over recent weeks, they're expecting that future path of policy to continue to wait for the trend of data to continue to worsen in the near term, while they're forecasting for Bank of America a shallow recession by Q3 of 2023. And Jamie Dimon saying things are still pretty good, but we've got storm clouds ahead. All of this would say that the Fed isn't finished yet. The banks aren't expecting that the Fed's going to be finished anytime soon. And they're waiting for a larger trend and much worse to show up in the data, which they're still using, of course, the lagged data on a lag to make some of these policy decisions as well.
Right. I mean, the Fed, it seems like the Fed is going to go at least one more time at its May 3rd meeting. That seems to be ahead of the quiet period that the Federal Reserve officials enter before that meeting. That seems to be the message that they're putting out there. The market has largely gotten it. They're pricing in that rate hike at that meeting. As we talked about in yesterday's morning brief, they're then pricing in a cut before the end of the year, which the Fed, at least if you look at the dot plot and also the rhetoric, they don't really seem to be getting there. If you look at the data, there does seem to be a little bit of more disappointment creeping in. That's the Bloomberg Economic Surprise Index. If it goes below that white line, which is 0, it means more data is missing than beating economist estimates, and it's just ticked below that line once again. It's fairly volatile, though, as you can see this year, but has been sort of trending lower. And just some examples of data this week that have missed estimates. We got the Philly Fed that missed. We got building permits that missed, although housing starts did beat estimates. So it's not uniformly bad. Empire Manufacturing beat estimates, was positive when a negative reading was expected. So it's not that it's this overwhelming flood of evidence that the recession is here right now, or that it is even that it is imminent. But it's just that things are sort of starting to deteriorate here. Yeah,
a larger question, too, in the meantime, especially as we're looking at home sales, where this starts to creep into the vibe of the consumer, if you will, because consumers, as we've already seen show up in some of the corporate earnings of past seasons for retailers, consumers have been very stringent about their discretionary spending, and at the same time, still waiting for what an actual recession may look like. they're hearing from the banks that, yeah, you guys you're healthy right now. The consumer environment is healthy, and that balance sheets for households are still healthy as well. So it's the larger question of when will we see that take a material hit to the point where it starts to trickle into even more so some of the consumer data, because as of right now, if you look at confidence or sentiment data, that continues to show that yes, the lower income portions of the economy, they have already been feeling the effects of inflation and thus perhaps already feeling what a recessionary or a pre-recessionary environment ahead of even a real shallow recession might look like. But now, as you start to see that creep in, as you've started to see that creep into the more affluent portions of the economy as well, that's where it begins to become this kind of level setting and realization that, okay, now we're starting to see the early moments of that, and it's just a matter of where that begins to continue to creep in to the spending patterns that we're seeing as well.
Yeah, we'll see. I mean, as you said, CEO after CEO has said the consumer is still relatively strong. So that brings us to thing number 2 this morning, which is Procter & Gamble. Speaking of a very consumer-reliant company, right? Procter & Gamble did beat on the top and bottom lines in the third quarter. 3 of its 5 segments did have volume declines as consumers pulled back on spending, but they're not really pulling back on spending. They're buying less stuff, but they're paying more for it. Yahoo Finance's Brian Sozzi sat down with Procter & Gamble CEO John Mueller, and they discussed the company's strategy in today's economic environment.
Well, the great thing about our strategy is that it is relevant and good in a good economic environment. It's equally or more relevant in a difficult economic environment. So the superiority of products, again, product, package, communication, go-to-market, good value for consumers and customers. You would want that in a good economic time. It's critical in a difficult economic time. A focus on productivity and cost control, very helpful in a good economic time, critical in a difficult economic time.
And so there you heard the comments directly from the company. And in those 3 segments that you were focused on a moment ago that declined in this most recent quarter, at least on the volume front, grooming, fabric and home care. You also saw baby, feminine, and family care decline. So those were all kind of single-digit percentage declines, but still holding up right now. And this is what I've talked about even months ago. Last year, one of the areas that continues to really kind of show some strength, in, even when you do have an economic downturn, areas like these little luxuries like beauty, accessories, things of that nature, things like your cup of coffee even. So it'll be interesting to see what Starbucks says when they do report later on this earnings season as well.
Yeah, and just to take a step back here, the big picture for Procter & Gamble is, as we just showed from the volumes, beauty notwithstanding, people are buying less stuff. Yeah. But they are paying more for that stuff. That is the calculation at Procter & Gamble. Just to put numbers around it here, unit sales, that is volumes, overall, were down 3%. Organic sales, excluding acquisitions, up 7%, and that's because they raised prices by 10%. So even if people didn't buy as much stuff, when you raise prices by 10%, you're able to make more money. That's how the economics of P&G are working right now. And a lot of costs have gone down now for the company, or at least are starting to abate.
Right.
But there are other costs that are still on the rise that the company is dealing with. So we're in an interesting moment for many of these consumer staples companies in terms of that volume versus price calculus.
And it's the calculus for the consumer of where you're willing to compromise. And for a lot of the hygiene products that perhaps you've become accustomed to over years, that's where you see less of a compromising and just taking on some of the price in this near term. Even if you are buying less, you're still just saying, all right, I still want to stick with the brand that I know that I've used time and time again. And that's a benefit that P&G has. However, if you're a Target or a Walmart, then you start to say, all right, how do we upsell into the trade down consumer, into a consumer that just says, you know what, I just want to make sure it works when I'm trying to clean the tiles in my house, or if I'm trying to just make sure that I'm not perspiring all over the place in these hot streets in New York. So at the end of the day, I think that's where we could see even more of that trade down start to be discussed from the retailers themselves, who have been doing more of the private label or homegrown brands and pushing and promoting that to their customers as well.
Yeah, so there's that implication. There's the implication also, of course, for the other consumer staples companies. P&G really the first of the big ones that we're going to hear from. We were looking at a board of some of the others just a moment ago. So does this tell us how writ large they're going to do? Some of them have managed this price increase transition better than others.
Right.
So I think we're going to obviously be seeing that in some of these numbers here.
I'm not trading down on the deodorant. I can't do that yet.
No?
No,
What's
no,
your,
no.
what's your, do we, am I allowed to ask what your deodorant
I'll
is?
tell you in the break.
Okay.
It's a good one. Best deodorant. Guys, more layoffs are bleeding into corporate America. Clorox announced its second round of job cuts as it looks to trim costs and adapt to changing consumer preferences. And Whole Foods is reportedly cutting several hundred corporate roles, according to the Wall Street Journal. The grocery chain, which is owned by Amazon, will now operate across 6 regions instead of 9. No stores or facilities will be affected by this. Clorox and Whole Foods join a list of companies from tech firms to retail giants who have been cutting costs in the face of recessionary fears.
A lot of discussion going around from C-suite leaders on the state of the economy, especially after the banking stresses in March. Let's listen to what executives have said so far this week.
The last decade, we have been living on abnormally low interest rates and probably broader credit availability than has been historical norms. And when that happens, invariably, you see the repercussions in things like Silicon Valley Bank.
So we're not seeing a lot of trade down. We're seeing, if anything, more careful usage of the product that I have bought. But generally, again, just look at the numbers. The consumer is holding up extremely well.
We don't see the activity on the consumer side slowing at a pace that would indicate that, but we see, commercial customers are being more careful and things like that. But everything points to a relatively mild recession.
People need to be prepared for the potential of higher rates for longer. If and when that happens, it will address problems in the economy.
I like that. It will undress problems in the economy. It will reveal problems in the economy. So I think the takeaway, and this was the subject of the morning brief, the takeaway is that while if you look at the surface of the economy, those banking stresses seem to have abated. But what some of these CEOs, particularly the financial industry CEOs, are saying is you're still seeing it sort of percolate through and have some effects. And that's something that people still need to keep an eye on.
Right, and they have a lot of incentive to make sure that there is still a ton of confidence in the banking system as a whole. But of course, at the same time, we have to think about the fact that many of them also are so large that they've been able to kind of abate the larger risk that a lot of regional banks have incurred over that time. And so for the larger banks that we have heard from, it's been amazing to hear and good to hear that they are dealing with consumers or seeing consumers be more resilient and saying that things are still pretty good right now. But at the same time, moving forward from here, I think now it's a matter of where are they continuing to shore up confidence in this rising rate environment for so many of the products and the financial lending capabilities that those financial conditions are not worsening so much so that it would be detrimental to the relationship that they have with a lot of the consumers that come to them either for a bank loan or just to get that house or even, just an auto loan at the end of the day too.
Yeah.
As corporate executives air out their economic perspectives, we're taking a look at earnings and what earnings are signaling about the economy. Here to discuss this and more, we've got Globalt Investments Senior Portfolio Manager, Thomas Martin. Thomas, great to have you here with us this morning, and thanks for taking the time here. If there's an overarching theme that you're able to kind of draw a through line on for all of the earnings that have come forward early this season, is there one that kind of rings out or resounds for you?
Yes, well, thank you guys for having me on this morning. And to answer your question, the resounding theme is that we're still very much in early stages of this normalization process. And this earnings season, this first quarter, is really showing that. We're getting a lot of mixed indications from the various companies that are reporting, even ones that are in the same industry. And so there's a lot that needs to keep on going on. And I'm afraid we're going to have to wait for another quarter or two before we really get definitive information one way or the other.
We were just showing some of the mixed signals via the reports that you were talking about, right? That we had the likes of a J.B. Hunt, which is negative, which doesn't, if you think of trucking as an economic bellwether, well, that's not, or logistics, that's not necessarily a good thing. The airlines and home builders perhaps more on the consumer side. So is there anything, even though it is a murky picture, are there any things that you have sort of pulled out of these earnings season as themes that you want to pay attention to?
Well, we definitely want to be paying attention to the things like Procter & Gamble that you highlighted earlier, and this difference between pricing, the ability to get pricing, and the ability to sell units. And you highlighted it perfectly, is that when inflation is being fought by the Fed and the central banks, and we all want it to come down, companies that are relying on pricing but are not getting that unit growth, that could end up being a problem going forward. So for this quarter that Procter & Gamble reported, it looks as though it's a mild decline in units, and they're still getting pricing. But as that dynamic changes, and if it becomes more negative, then these companies may be forced to continue to lay off more employees, and then that will raise the unemployment rate and make it more difficult for the consumer to remain strong.
Do you think we're due this earnings season for another guidance reset?
It doesn't appear that we are so far. It's all idiosyncratic. And so some companies are resetting earnings to a fairly large degree. But it's interesting, particularly, say, in the semiconductor area, those expectations, even though there's a reset, are being taken in stride. So, the market and investors are looking for that bottom. And we're really just in the beginning stages of the downside.
And so if that's the case, Thomas, right, and all of these signals are relatively murky, we don't know if a recession is going to happen, we don't know how severe it's going to be. From a strategic perspective, do you just discard sort of top-down analysis and just try to pick good companies?
That's a great question. And it always makes sense to pick good companies that have good fundamentals and good managements. And more so in very difficult times and trying times. You really get to see those managements that are doing well at making the decisions. And so, especially in this time, it makes a lot of sense to go towards quality companies that have growth that will be less impacted in a downturn. So less cyclical, less beta type companies, less ones where you're making a bet that things have to go right. So quality for sure in this environment.
Where does ESG sit within a quality evaluation, perhaps? Because this is something that we've heard about from everyone from the oil and gas companies that are trying to say, hey, yeah, we'll put these targets out there, which, in the meantime, they're going to try and maintain as best they can the profits that they are getting. But then, even more so, Larry Fink, Jamie Dimon, these large financial institution CEOs that are saying climate risk is not just a societal risk, but it also is an investment risk as well if you are not putting that into your portfolio somehow. How are you evaluating ESG in this environment?
Right. Well, in our fund, the way we look at ESG is not so much on a values-based or an activist-based or an agenda-based type of investment profile. And within the last year, certainly you've seen the kind of the battleground and the backlash really start to bring to the fore in the ESG area. And I think it's important to note that really these metrics are new and they're trying to measure risks in the portfolio at base. So once you get beyond a lot of the hype and the positioning, it is how are these companies thinking about these risks going forward? What can the impact be on their earnings and on their end markets and on their employees? And that's what we're trying to find measurements of and then incorporate in the portfolio. And a lot of it comes down to a better management, better awareness, and better quality in the companies. So at the margin, you're looking for those kinds of things as companies report these metrics.
Thomas, thank you. Thomas Martin, Global Investment Senior Portfolio Manager. Appreciate you spending some time with us this morning.
Great. Thanks very much. Thanks for having me on.
Thanks. Coming up, Tesla reverses course a day after shares slumped nearly 10%. Company changing prices yet again. We'll tell you what they're doing next. Software maker SAP beat profit and revenue estimates in its latest quarter as it forecast operating profit for the year above analyst estimates. The shares up about 4.3%. Of course, this is Europe's largest software maker, but it trades here in the U.S. under SAP as well. And the newer CEO, Christian Klein, has been sort of pivoting to cloud. Everybody's been pivoting to cloud. But that seems to be sort of continuing to pay off if you look at some of these numbers.
Yeah, that cloud pivot was happening when I was working there way
I
back
guess
then,
it's been happening.
back in the early 2010s and so forth. But as of now, this is a company that has made a lot of investments across its HANA suite, which is kind of more of like the high-speed analytics that you can think about there. But that cloud revenue up 77% in this most recent quarter, so that noteworthy. Their backlogs, and it might be worth doing kind of a deep dive or a breakdown, at least, on some of the terminology you're going to hear about with some of the ERP companies as they
I would
report
benefit from that.
the remaining performance
that.
obligations, the backlogs, all of these things. Important to know
Bookings.
about bookings. So much there. But within that, they're seeing a backlog of about 25%. That is higher. And then additionally, noteworthy here that this is also a company that divested from Qualtrics. Of course, that was a $8 billion deal, I think
Yes.
it was, when that came forward several years
I think
back.
that deal is not done. It has not closed yet.
Has not closed,
but
but-
they've come to an agreement to sell that stake. Yes.
Exactly. So they're basically just reaffirming their outlook for the operations, including some acceleration of top line and operating profit growth as well here. But updated some of the results to reflect the Qualtrics divestiture as well. They noted.
The artist formerly known as Schlumberger is out with numbers as well. Apparently, it formally has changed its name now to SLB, which is the same as its ticker. The shares aren't moving much this morning, even though the company beat on the top and bottom line. It did report weaker than expected cash flow and also noted its North American onshore market could see activity plateau this year, which is interesting. This was its best first quarter profit in 8 years as it saw an increase in its fee revenue, which is interesting.
Yeah, the CEO, Olivier Lepouche, I believe I pronounced that correctly. I'm sorry if I did not. But the quarter was defined by strong activity dynamics offshore and in the broader international basins, most notably in well construction and production systems. So those some of the catalysts for the quarter. There you're taking a look at the cash flow from operations coming in at $330 million. And then additionally here, the net income attributable to SLB of $934 million. That increased 83% year over year. So some really strong catalysts driving that increase in net income in this most recent quarter as well.
Yeah, and this is something that we've seen for a lot of these different oil field services
Yeah.
companies, right? That we have seen strength there. It is interesting, that commentary about how we might see activity plateau there. And then I think that's something that perhaps investors are going to be paying more attention to. The stock's actually a little bit lower this year. After we saw a big increase in a lot of the energy stocks last year. Energy this year has been an underperformer. And it looks like in this particular report that analyst coverage and analyst commentary, I should say, is focused on that cash flow number and saying that that number was disappointing. Cowen saying free cash flow was, quote, weak and below consensus, but that's not unusual for the first quarter. So that's something that people are looking at. And it looks like that the longer term outlook seems to be relatively positive. That comment about the plateauing notwithstanding.
So this is the last time we get to say Schlumberger is what you're telling me.
We can still
We can still say it? All right, cool.
Yeah,
All right. They'd like us to say SLB, but I guess
We can say both.
we're saying both. Schlumberger.
We still say Meta and Facebook,
We do. I still say Google as well.
as do we all.
Switching gears, everyone. Tesla pulling a reverse play on prices. The EV maker raised U.S. prices for its Model S and X premium electric vehicles on Thursday. This comes not long after telling investors that it will focus on volume growth earlier this week. And if your head is spinning, you are not the only one. I think for Tesla and for all of the demand that they've tried to drive, and I mean, they went out to the investment community, basically said that we're willing sacrificing near-term margins or near-term profits to make sure that we just get more people in the Tesla ecosystem that we can later on upsell or get them to put add-on packages on and so forth. But the environment is going to become more competitive, and I think that's what Tesla is also sensing here with the price cuts that they made. However, on the S and the X, that's a premium tier product anyway. So if somebody's looking to spend $75,000 on a car, then they're probably still going to be willing to spend $65,000 to $75,000 to maybe even $80,000 on that vehicle.
Right. It seems like that they're raising these by $2,500 a piece. So to your point, if you're already willing to spend that amount on a car. That is a less price elastic consumer, so to speak, to put it in that way. That said, it's really a marginal move as well in terms of what it's going to do for Tesla, because they don't sell as many of those cars. They sell many fewer of those higher end vehicles than they do the lower end vehicles, even though they do cost more and presumably are more profitable. But that's something to keep in mind as well. It just shows that Tesla is really it's trying to figure it out, right? The company is trying to figure it out. What is it able to do on pricing? What can it do in pricing in this environment? Even as I think questions are still swirling around what the actual demand picture looks like.
Yeah, I'm looking at prices right now for even some of their competitors in the luxury EV landscape. Mercedes EQE comes in at about $80,000. They just reported some surprise numbers, but it was ahead of what the expectation was, which they were required to report ahead of time because of some of the German law as well, if your numbers are going to be drastically different.
Yeah, MSG Entertainment ringing the opening bell. I was trying to see if James Dolan was up there. I don't think he is ringing the opening. Yeah, I don't think that is who is ringing the opening bell, but nonetheless, that's who's ringing the bell this morning. Maybe that is him up on the podium. I don't know.
Big time for MSG.
I'm looking at old photos. Somebody said in my head, JG in the straight shot, because James Dolan, of course, in addition to being quite a figure in New York, because of the Knicks and because of MSG, he's also a musician. He plays out. I don't know if you know this.
Really?
Oh yeah, he has a band, and I'll tell you more about it later.
Yeah, no. I mean, big time for the Knicks right now. Good for them, but I think my Sixers are still the best in the East, so I'll just put that out there. Got to say that.
I have no opinion on these matters.
All you need to know is let's go Sixers, right?
Sure.
Yeah, there you go. 76ers strong out here. Okay, well, eventually the market screen is going to load up here for me. I was trying to stall there for a hot second, but as we're taking a look, and we've got them in the bottom corner of your screen there, so you can take a look at it. Here, let me just opt on over to a different view here so that we can ultimately take a look at the S&P 500 at least and get you a look at how that's doing. The S&P 500 here on the day, you're seeing it flat just barely to the upside, opening in the green as of right now, but we'll see if we hold on to those gains here. Some slim moves higher, up by about 1 point right now, and you're taking a look at the 11 S&P 500 sectors as of right now. You've got more gainers than decliners, really led by staples right now. 0.9% in positive territory, but bringing up the caboose, you've got XLF, you know what that means, financial sector, that is in the red right now by about 0.6%. Technology, that down by about 0.5%. We're going to get some big earnings on the technology front next week, and we're going to be breaking down many of them during After the Call. Yes, a subtle tease there. Also, taking a look at XLY, you're seeing that higher on the day by about 0.9% out of the gate this morning. I want to take a look at the tech-heavy Nasdaq, just paint a little bit of a picture for you as to where those mega-cap tech stocks are moving out of the gate this morning. And on this, the final trading session of the week, Apple, Microsoft, both of those in the red. Google, Alphabet, Alpha Google, whatever you call them in the green. And Amazon, ooh, interesting. It's up by about 2.6% on the day. So we'll continue to track that. And then just lastly here, I wanted to take a look at well, I could have pulled it up right there, but Tesla anyway on the day, as long as we got it. There we go. Okay, Tesla, you're seeing that up by about 0.1%. And let's just put this broader kind of move in context that we've seen over the course of this week. And you can see exactly when they reported earnings. Yeah, that was, well, we don't need to draw it. You can see it. Ultimately, here over the past 5 days, down 11% this week for the electric vehicle maker post earnings that kind of shocked analysts and the street out there.
Seeing that Amazon move upward prompted me to try and figure out what was going on there. And I'm seeing a note out of JP Morgan that Amazon is the company's best internet idea into the reporting season for big tech, which is quite interesting there. So we'll keep digging into that, but that seems to be the catalyst behind today's move.
Super original, yeah.
Hey, you got to pick something.
Yeah.
All right, we're going to take a break. Coming up, high inflation, recession concerns, not a problem for Procter Gamble. CEO John Mueller touting the strength of the consumer and the company's strategy following a big earnings beat. We've got the full interview with him on the other side of the break. Putting AI to work. Our next guest predicts an explosion in productivity, what he's calling a productivity revolution with the assistance of artificial intelligence. Matt Calkins is Appian founder and CEO. He's joining us now. So Matt, these are big, sort of impressive words, right? A productivity revolution. How does that work? Is it really going to be as revolutionary as all of that?
Yeah, well, our economy takes productivity seriously only when it's in a pinch. Only when the labor market is difficult and money is hard to get do we solve our productivity problems, our scaling problems by something other than writing a check. But right now it's going to happen. Companies across the nation are going to be asked to do more with less in the year ahead. And so they're going to turn toward technology to try to be more productive. And when they do, they're going to find out that there have been vast leaps in productivity technology. Digital workers can do so much more than they used to be able to do. And that's why we're going to see that revolution, I call it, in productivity.
Okay, so in this revolution in productivity, you also say that you see us entering into a new era where AI will need to be combined with people to drive productivity. So it's not like AI is just going to take all the jobs, right? It's kind of an in tandem workforce that we're seeing between augmented intelligence, if you will, combined with the human intelligence factor.
Yeah, AI is definitely not going to take the jobs. AI needs humans in a partnership to be effective. We've seen AI do amazing things this year, but we've also seen it make amazing mistakes. And we're in a multi-year pattern starting now in which AI will write something and a human will have to edit it. AI will propose something and a human will have to make the decision. AI is not ready to do this, maybe never, but certainly not now. There's going to have to be a well-knit partnership, which makes all the sense in the world to us. I come from Appian. A purpose of our organization is to foster that partnership between human and digital workers.
And I want to get to more on that in a second, but I want to zero in on something you said, which is AI is not ready, right? But it is dominating the conversation right now. So where are we in that process, and how do we get to, and how soon will we get to the future that you're envisioning?
It's going to be longer than you think. AI is amazing us with its capabilities right now, but what we're seeing is AI at its best, at the narrow thing that it's been designed for. But you take it to the edge of the data pool where the pool is shallower and you don't have as much research, and AI breaks down in surprising and sometimes disappointing ways. Solving what AI can be when its data pool is thin is a decades-long problem. We're not going to solve that right away. We're right now rightfully impressed with what AI can do when it's richly informed with information. But the true challenge, we all live in an environment where we have to make decisions on limited information. And for AI to compete with us, for it to be ready to do a human's job, it would have to find a way to make decisions on limited information, on changing data sets and ever obsoleting data sets the way we are capable of doing. AI is a long way from being able to do a thing like that. I don't know if it'll ever get there.
Matt, last time I had the chance to speak with you, it was on the day of your IPO. I remember it very vividly. It was a big year as well for some of the tech names that were going public at that time. You think back then, and now fast forward to all of the discussion around AI and what that means for everyone's business, how quickly do you believe that we'll see tangible or at least visible results in the financial statements that companies have, companies like Appian, that include the benefits of AI?
Yeah, the benefits of AI are right upon us. You're going to see the difference immediately. One trend I think will surprise you is the fact that most organizations prefer a private AI to a public one. They're going to want to cultivate their own AI algorithm rather than sending their data out to a major firm to review and to parse, which means that the AI revolution is going to be an in-house revolution. Organizations are going to be looking for a way to cultivate and train their own AI off of a public model. We'll have an announcement on something like that next month when we talk about a low-code AI that allows organizations to train their own internal AI. I think that's going to emerge as one of the primary challenges, but it's set to go. There's going to be benefits this year, meaningful productivity benefits, bottom line benefits from AI right away because it's so powerful.
Well, and we've been talking about this, as you talk about how it relates to your company, obviously you have a vested interest, right, in AI for productivity. That is part of what you do. How big is AI? And the new conversation we've been having about it is really a different generation of AI, right? Artificial intelligence has been around for a long time in terms of analyzing data, et cetera. How much of what we're talking about is large language models or the next phase of AI, and how much of it is just the old-fashioned stuff or old-fashioned, but the technology that you've been using for a while?
There's different dimensions of AI. It's all about machine learning and training algorithms. Generative is different, but it's not necessarily better. It's just another dimension that we've now become exposed to, and we see how powerful it is. But AI is going to be transformative in all these dimensions. And our job is just to make it as useful as possible, which generally means pairing it with human help. And AI can't make a decision by its own. Instead, we're going to have to collaborate amongst the different workers, digital and human, in order to get to the ideal outcome.
Matt, great to see you again. Great to have this conversation, and hopefully the AI doesn't replace us by the time we get to speak next. Matt, appreciate it this morning. Thanks so much. And everyone, coming up, high inflation, question mark, recession concerns, question mark, not a problem for Procter Gamble. CEO John Moeller touting the strength of the consumer and the company's strategy following a big earnings beat. We'll have the full interview with him on the other side.
We've got breaking PMIs, Purchasing Managers Index here for April. The composite PMI coming in at 53.5. That is ahead of estimates and ahead of the prior month, ahead of the estimate for 51.2. And then there are two components of this, right? There's manufacturing, which came in at 50.4. That is better than estimated as well. And services at 53.7. All three of these measures coming in higher than economists had estimated. And as I like to always remind you folks, 50 is the dividing line between expansion and contraction. So it's especially interesting here to see that manufacturing number come in above that 50 mark. I'm not quite sure when is the last time that we had that, but I believe it's been a minute here. So just looking at the release, and I know you have this up too, Brad, to try to see some of the commentary around here. New orders at U.S. firms, that's standing out to me, increasing at the sharpest rate for 11 months in April. So that's a positive thing here. So one of my takeaways, just like first blush takeaways here, is we've been talking about a week, I should say, of mixed economic data, with some of those data points coming weaker than estimated, right? Here is the freshest data that we have. This is an April preliminary read that is coming out ahead of estimates. Just like when you wanted some clarity on the economic picture, either to the up or to the downside, this is not the report that's going to give it to you, because this looks like it is a pretty darn strong report. Yeah,
this is, it creates quite the conundrum for any Fed member who is looking across the wave of economic data that we've seen come through, trying to discover what's bad, what's good, separate them from each other, and try to figure out where trends are beginning to formulate. Here on the manufacturing supply chains, interesting to note, they continued to improve during April. The respective index little changed from the survey record upturn seen in March, and suppliers' delivery times have now shortened for 3 months running, with goods producers citing improved raw material availability and lower demand. However, survey respondents noted ongoing difficulties with sourcing electrical items and supply constraints across Asia, which is particularly interesting to note given the international reliance on just sourcing those raw materials, and what we've been continuing to monitor within a resurgence within Asia Pacific and that region as well right now.
Something else that is a problem for the Fed: prices are still going up. So in the services part in particular, according to S&P, selling prices increasing at a sharper pace, firms responding to higher cost burdens by passing these through to customers where possible. The rate of inflation accelerating for the third month running, and was the quickest since last August. That is not something that the Fed, or for that matter, people who are thinking that the Fed's going to cut rates this year, are going to want to hear here. And again, that was on the services side, although on the manufacturing side, it talks about notable hikes in supplier prices driving up the rate of cost inflation in April as well.
Yeah, the chief business economist here is saying in a quote that the key takeaway for now is that the economy as a whole is not only showing encouraging resilience, something that we've continued to hear from the banks, but encouraging resilience, but has gained growth momentum heading into the second quarter. That's according to the latest PMI reading, broadly indicative of GDP rising at a robust quarterly rate of 0.4%.
Good and the bad.
Yeah, exactly. All right, we'll continue to monitor the market reaction to this. Switching gears, Procter Gamble beating estimates on the top and bottom line in the latest quarter as high prices offset lower demand for its products. The company also raised its full-year forecast. Yahoo Finance's executive editor Brian Sazzi sat down with the CEO, John Moeller, earlier today, who said the consumer remains resilient. Take a listen.
We had a great quarter from a top-line standpoint, as you're indicating. Over 7% organic sales growth, every category growing. Both of our major regions, the focus markets and the developing markets, growing 5% and 15% respectively. But underpinning that is a degree of consumer resilience, but there's also a degree of intentionality in how we've structured this portfolio and executed our strategy, which is based on continuing to innovate to improve the superiority of product, package, communication, our go-to-market execution, value for consumers and customers. And as we bring innovation to the marketplace, the value proposition, inclusive of performance, increases. So we haven't been standing still in terms of what we're offering consumers. At the same time, we've built what we refer to as portfolio ladders, giving consumers the opportunity to trade down within our brands if that's relevant to them. So you can buy Tide Power Pods at 50 cents per load. You can buy regular Tide Pods at 30 cents per load. You can buy Tide Simply Pods at 20 cents per load. So we've tried to be very, very intentional and consumer focused in maintaining and increasing the value that we're offering to her every day.
Has P&G, just given the focus with consumers on finding affordability down the shopping aisles, has P&G had to come out with more entry-level products?
As I indicated, over the last number of years, we've been filling out our portfolio in that regard. We've also been very intentional on ensuring we have pack sizes that are designed for low cash outlay capability. We've ensured that we're present in a relevant way in the channels that typically benefit from any kind of a downturn. But, in terms of this being a major descriptor of the environment today, that's not what we're seeing. If you look at private label shares as a proxy of trade down in our categories, they're up very modestly, 0.2 points in the US past 3, 6, and 12 months. And at the same time, we've been building share. In the quarter we just completed, we were up 0.4 points in terms of value share, up 0.9 points in terms of volume share, growing the US business 6%.
I've talked to a few consumer-oriented CEOs recently, John, and they are calling out, their words, not mine, stress on the lower income shopper. What do you see with your brands that touch that consumer?
Again, we see consumers across the pricing spectrum define value in a very comprehensive way. Price is an important component of almost everybody's value equation, and certainly more of a component at the lower end. But so is performance, so is aesthetic, so is usage experience, so is the sustainability of the offering, and all of that comes together to inform brand choice. We've intentionally designed our category to focus, our portfolio on categories where brand choice is driven predominantly by performance. And so we're not seeing a lot of trade down. We're seeing, if anything, more careful usage of the product that I have bought. So I might use a half a sheet of a Bounty paper towel as opposed to a whole sheet. But generally, again, just look at the numbers. The consumer is holding up extremely well, and part of that reflects our service of him and her.
Let the record show, John, I remain a full sheet type of guy for Bounty. I just wanted that to be known out there on the interwebs on your earnings day. Two businesses that stood out to me on an operating profit level: fabric and home care, operating profits up 21%. Baby, feminine, and family care up 11%. Unpack those gains for us. Is it price driven? Because those are some of the biggest gains you saw in the quarter from an op profit line.
We're making good progress in recovering significant commodity inflation and significant foreign exchange impacts, both of which hit that margin line. And we're doing that through a combination of pricing, as you indicate, mixing up to higher value, albeit premium products, and a significant continued focus, steady focus on cost productivity. And those categories, if I were to unpack each of them, you'd see those components carrying the day. The team, if you look at the last 2 years, we've had to overcome, and the team has more than overcome, $7 billion after tax in the impact of commodities, foreign exchange, and transportation costs. That's 50% of our earnings. Last year, we grew earnings per share. This year, we're forecasting modest growth as well, while maintaining investment in that very strong top line, expanding our margin of superiority, growing markets, getting to more households and improving their lives.
Called out within the guidance, John, $2.2 billion commodities hit. I think that sounds pretty around the same lines of what we saw from P&G when we last spoke on the last quarter. But as you look forward out over the next 12 months, given we have seen a pullback in a lot of commodities, how does that pullback impact your bottom line? How do you anticipate that playing out?
Hopefully positively, but we're still very early in understanding our plans and developing our plans for next year. And there are other things that I think you'll readily appreciate are going the other way. Things like labor cost, things like interest expense. So we'll have to net all that together, but I expect us to continue to face significant challenges from a macro standpoint for the foreseeable future.
And then on those macro challenges, to be clear, you're not seeing anything in your business right now that a recession is imminent or a sharp economic slowdown?
We are not.
Okay. And then lastly, we're asking all leaders, John, of your stature. It's been a weird time in the economy. I mean, in March, we saw bank runs, people outside of banks trying to get their money out. I've never seen anything like that before. A lot of the leaders that I talk to, they haven't seen that too. To the extent you could, bring us inside the C-suite. When you saw those things happening, what did you tell your executive team? And how do you manage through a crisis like that?
Well, the great thing about our strategy is that it is relevant and good in a good economic environment. It's equally or more relevant in a difficult economic environment. So the superiority of products, again, product package, communication, go to market, good value for consumers and customers. You would want that in a good economic time. It's critical in a difficult economic time. A focus on productivity and cost control, very helpful in a good economic time, critical in a difficult economic time. So we're really trying to stay focused on what we can impact and deliver. And if we do that well, we'll be in the best shape we possibly can be, whatever that looks like. And if we don't, whether it's a good economic environment or a difficult economic environment, we won't be. So the focus is clear, it's steady, constant, and the team is doing a brilliant job of executing against it.
John, real quick, just to tap into your former CFO mind. I mean, on days like that, are you calling the banks? Like, what is your day like?
I'm calling our CFO.
And what advice do you give him as someone that was in that seat? What do you tell him?
Well, he's perfectly capable of, he's a great talent and is doing a super job. So there's not much I need to tell him. I'm more just offering my presence and perspective if he would find that helpful, given, having gone through 2008 as treasurer, and then, as you mentioned, for 12 years after that as CFO. But I'm focused primarily on those kinds of days on just continuing to advance the strategy. And, a company like Procter Gamble, while with its credit profile, generally shouldn't get overly exercised with minor moves within the credit market or in the things that affect the credit market. We'll be just fine. That was the case in 2008. It's the case today.
Coming up, things could get pretty ugly in big tech earnings next week. So what should investors be looking for? And will AI dominate the headlines? Well, probably. But we'll discuss the rest of it next. Welcome back to Yahoo Finance Live. I'm Julie Hyman with Brad Smith. Let's take a look at markets here, not just on the day, but of course it's Friday. So let's take a look at what's going on the week. We have the Dow Jones down about 0.4%, worst week since March. The week ended March 10th, but it's not a big downdraft, right? Just 0.4% here. The S&P 500 similarly down about 0.5%, and the Nasdaq is down about 1%. That's just its worst week in about 2 weeks when it was also down about 1%. And then switching on over to some of the heat maps here, I want to get a recheck on some of the ones we were talking about before, and in particular Tesla. This is a really interesting one, right? Because earlier we were talking about it rising because after it has been cutting prices, announced overnight it was raising prices on some of its higher end vehicles. Initially, the stock was higher, and now it's gone lower. Let's take a look at a 2-day chart to show you with the earnings reaction yesterday. Well, it's still down 10% over the past few days, so it has not really seen a recovery, and we're seeing red pretty broadly now across the Nasdaq 100, with the notable exception of Amazon, which, as we talked about earlier, got some positive commentary out from JP Morgan, but even it has trimmed its advance for the day. So interesting to watch that there. I'm going to check on the lead board here. This is one that Jared likes to look at, that looks at sort of the sentiment leaders, if you will. So seeing in the green here today some of the biotech stocks, but then at the bottom of the pack, oh, this is an interesting one. We've got the CraneShares Trust China Internet ETF. That's the 2-day chart here. If we look at the 1-day chart, we see it down about 2.7%. So China Internet not doing well in today's session. Semiconductor stocks also getting hit today, which is another interesting, maybe leading indicator, especially going into technology earnings next week. Semi seen as leading broader tech because, well, lots of tech uses semiconductors. Brad?
Great chips there. All right, we are getting plugged into the tech sector, as some of the biggest players are gearing up to report their quarterly results next week in technology. Joining us here with insights on what investors should keep a lookout for in the coming week, we've got Josh Wine, who is the Hennessy Technology Fund Portfolio Manager, along with Bob O'Donnell, Technalysis Research President and Chief Analyst. Great to have you both here with us. Teeing up tech earnings, and Bob, I want to go to you first here on this, is artificial intelligence and a mention of that or a nod to how that is going to be this revolutionary technology that's embedded within a company's solution or search engine. Is that enough to be a search engine savior over the course of this earnings period?
Well, not over the course of this earnings period, Brad, but look, I obviously things like generative AI and the impact that it's had already are going to play themselves out over the next several quarters. All right. This is, none of this stuff happens overnight. But there's no question, if you look specifically at search, right? I mean, you've had Google dominating search for decades, frankly, and Microsoft comes along and really starts to rethinks search with what they're doing with the ChatGPT influenced Bing. And people all of a sudden are like, wait a minute, that is a better way to search. I'm getting answers. And of course, Google's scrambling to provide sort of similar capabilities. So, I mean, the challenge for investors is, look, near term, it's going to be tough. Everybody knows this next quarter is going to be tough. But if you're thinking longer term, and these are longer term trends, there's some huge potential impact here from a lot of the players who are involved, and big question marks, frankly, from the customers or the big players who are not yet involved or don't have a clear strategy around generative AI.
Josh, I want to bring you into this because, yes, the big picture of AI notwithstanding, companies got to get through this year. And this year, for many of them, is going to be challenging, right? We've already seen those challenges. We've already seen a lot of job cuts and whatnot. And I know you don't make your investment decisions based on a quarterly reporting basis. That said, I know you're going to be watching the numbers. Is this going to be a lousy reporting season for big tech?
Yeah, I mean, I think it's good to be with you, Julie. I think it's going to be a fine season relative to other sectors. I think technology is still one of the few sectors that's expected to report some measure of earnings growth. But, as for things like AI, I mean, I think it's interesting. We own Meta and the Hennessy Technology Fund, and they've certainly stumbled a little bit. I mean, Meta's a great company generating great returns on capital and all that. But, AI, as exciting and as impactful as it is, I think for a lot of companies, especially the ones that can capitalize on it, like a Meta, and I think it's been an enormous distraction to the extent that there's been a lot of hiring and a lot of big plans that have, that they've had to unwind to some degree. So I think ultimately I think what I listen for is maybe more the users of AI and not the companies that are generating, AI software or AI algorithms. I think it's the users. It's kind of like the picks and shovels versus the gold miner. Maybe buying the picks and shovels companies is the way to go there.
Josh, kind of further down that thought process too, for these companies, how do you see them monetizing generative AI? What is kind of the currency that's really going to drive the business model, the revenue model on the other side of this that they're going to be reporting on over time?
Sure. Yeah. I mean, I think a lot about AI and, kind of as the consumer sees it, booking hotel reservations and travel and kind of customer service applications of AI, and those have been around for a few years. I think that maybe more meaningful are large enterprises in any sector that, we've seen, especially in technology companies, these enormous layoffs. And what has come to light is that a lot of workers were hired in anticipation of the need for them, and they were underutilized or not utilized at all. And I think with AI, I think ultimately it displaces a lot of workers that, were of a lot of value. And now, AI can help answer questions or write code or whatever it may be. So I think AI is monetized by companies buying algorithms, buying software, and displacing, human capital. I think that's the silver bullet, for better or worse.
I mean, Bob, at the same time, does AI function as a convenient excuse in two ways? One, things aren't going so great at the company. Oh, but we're doing AI, right? And secondly, even if, yes, AI might replace some workers, although it seems early that that's going to happen on a larger scale, but at the same time, can it provide an excuse in some ways? Oh, we're using AI and we're also going to cut all these jobs.
Yeah, well, Julie, I mean, look, there's a ton of AI washing going on already, right? And we're going to see a lot more of it through this earnings period, the next earnings periods. So to be clear on that. And look, the other thing is, I think it's important that, as you pointed out, look, companies got to get through this year. And what I think we're seeing is a sense of, hey, what I need now are products and services that help me immediately. And generative AI is the one exception, I believe. But so what are the things that I can do right now? And so the basic fundamentals around things like cloud computing, right? We've got Amazon, Google, and Microsoft all reporting next week, all of which have, the biggest plays in cloud. I think you're going to continue to see that cloud computing growth, moving apace. Has the rate slowed down? Sure, it's slowed down because we're hitting the law of big numbers here. But if you look at the overall evolution of computing, there's still only a fraction, 25, 30% of computing workloads have moved to the cloud, which means there's a ton that haven't. Now, not all of them are going to be clear, but there's still opportunity there. So, and those are practical things. And as companies make these job cuts, they're having to be more productive with the people who are there. They're having to come up with new processes that allow them to achieve what they want to achieve. And a lot of that is going to be done through tech. So I completely agree. I think tech overall is going to be something that's going to continue to benefit because we've seen what it can do. There was an interesting comment in the IBM earnings from a couple of days ago that their CEO said, which is, look, they're not canceling projects, they're delaying projects, right? They're being practical and focused on it. And I think that's an important thought to bear in mind as we work through these tech earnings. The other last point I'll quickly make is there's obviously going to be a big difference between consumer tech and commercial tech. Mm-hmm. So companies like Apple that are very consumer tech focused, I think it's going to be tougher for them in the near term than the enterprise focused companies, because we are seeing businesses that is spend money to try and solve these challenges they have and figure out what they can do with the smaller workforce that they now have.
Josh, with all of this, I mean, before there was generative AI, there was, we were talking about this time last year, I think, the metaverse. Before there was the metaverse, there was NFTs. Before there was NFTs, we were talking about and tokenizing everything with NFTs. We were talking about blockchain. So all of this considered, how do companies who are looking to employ AI solutions, generative AI solutions, and be able to profit from them and create margins, how do we keep this from just being the next kind of Kool-Aid that's out in the street?
Right, I agree. I mean, yeah, there's always something that everyone is talking about on earnings calls, and it comes all of a sudden, and then it lasts for a while, and then it passes. Yeah, and it used to be kind of 3D television or something like that. So
I've got mine.
And what's become of that? So yeah, I think I don't think it's a fad, but I think the conversation and the narrative around it is a fad. I think that ultimately we're still so early in this, and there's, what we haven't even seen yet is the idea of regulation around AI. And certainly that's coming, I'm sure. Regulators want to regulate. So, I think it's very early. I think we probably aren't talking about this too much in 6 months, but it will still exist. It'll still be, there will be a lot of R&D around it, and it's, here to stay. You can't put the genie back in the bottle. And so, yeah, it's exciting. I mean, I think everyone should be excited about the prospect of it, but yeah, it's going to become another thing that everyone uses.
Indeed. All right. Thanks, guys. So looking forward to next week and getting all those numbers. Josh Wine is a Hennessy Technology Fund Portfolio Manager. Bob O'Donnell, Technologist Research President and Chief Analyst. Thanks, guys. Appreciate it.
Thank you.
Thanks.
We got a trending ticker for you. That's CSX, the railroad company, out with a beat on the top and bottom line. It saw earnings rise 15%. Revenue was up 9% year over year. The revenue boost was thanks to solid merchandise and coal volume growth, higher fuel surcharges, and pricing gains. Shares are chugging along higher this morning, up 2.2%. Coming up, I've been trying to think of Disney villains and heroes.
I mean, look at that hair. How's that not villainous hair?
Classic Disney villains and heroes. Do you have any favorites?
Classic one, Jafar.
Jafar. So I don't know who's who in this situation, but we got a classic battle of good against evil, or just two guys. Coming up next. Internet media darling BuzzFeed is shuttering its news division. The company now looking to move forward with news under its Huffington Post brand. But could the decision underscore broader issues in the digital media industry? Here to discuss the Syracuse Syracuse University Newhouse School of Public Communications magazine chair, Aileen Gallagher. Aileen, thank you so much for being here. It does, we in the media love to talk about the media, as we frequently say, but this does seem sort of emblematic of the bigger move in digital media. What are your thoughts?
Well, BuzzFeed is kind of a special case because of some business choices that it made. But also we see, once again, changes. The audience is changing and their habits are changing. So the audience is spending more time on social platforms that involve video, like TikTok and Instagram. And whereas before they would be on Twitter, they would be on Facebook and link out. Now they are kind of trapped in those platforms, happily trapped in those platforms. And it's really hard to fight to get content there. Was BuzzFeed ever properly run in order to be a, long-term, profitable, publicly traded company? Or was this more of a business that really kind of was able to grow because of the quizzes and listicles at the end of the day, and then was able to grow out and add on a media arm, however, that becoming more difficult because of the very audience they were going after from the outset? BuzzFeed News is certainly a prestige operation, and they did great journalism. They did a lot of important investigations into Russia, big pharma, tech, and disinformation. So BuzzFeed News closing is a loss for a better informed democracy. Business-wise, however, BuzzFeed News was always kind of a weird fit with a company that was kind of like the fun, goofy corner of the internet. And we see that when they're kind of doubling down on their original, cheaper content, like quizzes, and they're also using AI to generate those things. So it's not only cutting off the expensive reporting arm, but really cutting costs in just content generation altogether. Well, and I guess it's telling as well that some of the alumni of BuzzFeed News have moved to other, quote unquote, more serious news organizations. The Atlantic, for example, a number of folks have ended up over there. We also heard that Insider was cutting some jobs. That was another piece of news that dropped yesterday. So when you look at the overall digital landscape, in particular for serious news, kind of where are we? Is there enough resourcing out there right now? Well, again, a lot of the issue is with the social platforms, that's where the audience is. And just the way that people use the internet is different than the way that they used it even 5 or 10 years ago, as these companies were really building up their profiles and building up their editorial missions. So as much as we joked about the pivot to video probably about 10 years ago, like, this is the real pivot to video. And it's short form video. It is often user generated content. It is the audience making video for themselves. And so those of us in the editorial world are kind of having to take stock and figure out what happened to our audience and how do we find them. You mentioned that social media is the issue, but to what extent as well is new technology and generative AI, and how some of the organizations have decided to lean further into that instead of holding on to staff who would be writing these stories? I mean, it depends on how they're using AI. I mean, AI doesn't really help with new information. AI can only work with information that's already out there. So for reporting, AI can't report me a new story because it has to go seek new information that isn't out there already. But in terms of, the AP has been using AI for quite a while, as has Bloomberg and Reuters, I believe, to do earnings stories. One of my first jobs out of college was I was a business reporter, and I wrote earnings stories. And, that part of my job has been replaced by a machine. And that's okay, because it takes a lot of time to write those things, and that's time better spent on actual news gathering. Right. Information is the coin of the realm. And some of that is just pulling information from the press release, the earnings press release as it is. You mentioned the role of social media and social networks in this whole thing. And I feel I have to bring up Twitter and the current, every day there's something different, but now it's the blue check marks are going away. And this comes on the heels of some tension between Twitter and some news organizations like NPR over the labeling of those organizations. At what point does Twitter become, not useful for these news organizations, or are we still a long way off from that? Feels closer every day. The audience for Twitter has been flat for a number of years. So it truly is a platform. It is a news platform. And whether that news is coming from news organizations or celebrities, that is where you go if you want to find out what's going on in the world right at this second. But it's sort of losing that role somewhat, again, as audiences are turning elsewhere, but also as Elon Musk uses Twitter as a cudgel against his perceived or real enemies.
With my blue check mark, Aileen, I was once a member of the Capital Society, and now I am just a member of District 12 all over again. Aileen Gallagher, chair of Magazine over at the Newhouse School of Public Communications at Syracuse University. Thanks so much for taking the time today. We appreciate it.
Thank you.
If you're Florida Governor Ron DeSantis, Walt Disney World is certainly not the happiest place on earth. The battle between the politician and media giant continued this week as DeSantis proposed new legislation that would require Disney to adhere to further inspections of its theme parks. The move's the latest in now what is a years-long saga, although it's heated up lately. It includes secret last-minute agreements, power struggles, and more. Yahoo Finance's Alexander Canal and Rick Newman are joining us now to discuss. Allie's got the Disney side of the story. Rick has the political side of the story. And Rick, I want to actually start with you and the DeSantis role in all of this and how he has been sort of trying to ratchet up the pressure.
Well, just to remind everybody, people must be wondering, what the heck is this all about anyway, now that people at a more national level are starting to pay attention to DeSantis since he might be a presidential candidate next year. This goes back to last year when Disney, like a lot of other companies, opposed this bill that did become a law. DeSantis signed it, that limits what schools can teach young kids about gender issues. And DeSantis kind of singled out Disney because Disney made a kind of a tactical mistake back then when Bob Chapek was still the CEO. Instead of coming out against that bill at the beginning, when a lot of other Florida-based companies did, Disney didn't say anything. And then it sort of singled itself out by coming out in the middle of the process and saying, okay, we oppose this bill after all. So that kind of put Disney in DeSantis' sights. And he thought he was just going to have a sort of a one-off political victory here by taking away their autonomy, their sort of self-governing autonomy. Well, Disney flipped the script on DeSantis. They got this commission to say no. They actually have this autonomy locked in stone for some period of time, like 30 years into the future. So DeSantis now lost. He lost that political battle, and he had to decide what to do about it. Should he just say, "Forget it, I'm going to move on with trying to improve people's lives in Florida"? No, he said, "I'm going to win this battle no matter what." So now this is like a fight to the death at a political level between Bob Iger, the new CEO, who's also the former CEO, and Ron DeSantis. And it's about nothing. It's just about who's going to be the last man standing here. So I think DeSantis picked a battle that he did not anticipate how big it would become, and now he's stuck.
Yeah, that's quite the hill to choose, Rick. So Allie, Disney has called this move anti-Florida, anti-business. What more do we know about the reaction from Disney's side here?
Well, Bob Iger, he is not stepping back down on this fight. He did say those words, anti-business, anti-Florida, during the company's shareholder meeting earlier this month. He seems to continuously stand by those employees. In fact, earlier this week, in the middle of all of this drama, Disney announced its first ever Pride Month event. So I see that as a sort of direct 1-2 punch at DeSantis. And like Rick was saying, DeSantis is trying anything he can to try and regain some of that control. That's what that proposed legislation is intending to do, subject those Disney parks to further inspections, kind of be this ominous cloud, I would say, over Disney so that they know they are not in charge of Florida. The governor is. I mean, this has just drawn attention from political people from both sides of the aisle. We've heard from Donald Trump, Chris Christie criticizing DeSantis and the lack of ability to really rein in the company. Of course, there's some political motivations there since DeSantis is largely seen as a top opponent to Trump, although DeSantis has not announced his run for presidency in 2024. So this is something that both, Disney fans are watching and also those higher level political pundits are watching as well. So this is going to set an interesting precedent moving forward, I think, with corporations and how they handle certain policies.
I was loving the image of the cloud. Yes. I was almost like a Pixar movie, right? The cloud
It's like a movie
over Disney World. Rick, is there a way here, we're also hearing, by the way, that Disney is sort of lobbying in the Florida legislature to get through stuff that is favorable to it. Is there a way for DeSantis to back down now in a, I won't say graceful way, but in a way that doesn't cost him too much? It doesn't seem like that this is a winning position for him.
It's a great question, and I think we're going to find out whether DeSantis has the sort of shape-shifting ability that successful politicians at the national level really need, because you can't win on literally every issue. Here's what DeSantis thinks he's trying to do. He has declared war on what he calls woke capitalism. He thinks that is going to be one of the ways that he's going to ride into the White House in 2024. And I think what we're learning through this whole battle is what kind of traction this issue actually has. And I think it has very weak traction. What Disney is doing, by sponsoring pride events and things like that, and opposing the so-called "Don't Say Gay" bill. What Disney is doing, Disney's clientele is like all of America. And like a lot of big companies, they have to figure out what their customers want, what their employees want, and they have to react to the way social values are changing. And there's obviously a lot more acceptance of different, the trans people and LGBTQ people. This has changed over the last 30 years. And DeSantis is trying to draw this line in the sand and say, I stand for these old-fashioned values. And, news for DeSantis, America is moving on from that, and big companies are figuring out how to deal with it. It's not always smooth. In fact, sometimes it's pretty bumpy. But DeSantis is sort of lodging himself in like the 1970s. So there are graceful ways for politicians to say, let's make peace here. It's a real test for whether DeSantis has that tool in his toolbox. And what we know about him suggests he does not.
Yeah, again, to go back to the cloud analogy, I think of the meme of the man shaking fist at cloud in this situation. Guys, thanks a lot. Rick and Allie, appreciate it.
See ya.
Coming up, from volatility in the markets to advancements in AI, there's a lot to talk about at the Nasdaq. Sazi, look, he's there, and he's going to join us live in just a moment with two key executives. Now let's get to some notable executive changes for Nasdaq, with two division leaders moving up to president level. Those moves coming in the aftermath of a significant restructuring last year, the business reorganizing into three divisions. Yahoo Finance's Brian Sazi, our executive editor, is joining us from the exchange with the two individuals in question. Brian?
All right, thanks so much, Julie. Yes, joining me now is Tal Cohen and Nelson Griggs, the new co-presidents of Nasdaq. Congratulations to you both on the position. And Tal, I'll start with you because your last name begins with C. I want to give you both equal time here. Okay, it's the only way I can figure out how to do it. Now, like we just mentioned in our opener, you just stood up a new structure in late September, dividing the businesses in different segments. What will this change in structure now allow you to do?
Yeah, so this announcement today is really formalizing that realignment we announced late last year and put in place at the beginning of this year. And it really starts with Adina, who took on the chair position in addition to the CEO position, and that elevated her. And then at the beginning of the year, we also talked about 3 key themes we wanted to lean into. And those themes were liquidity, transparency, and integrity. And so then we reorganized our businesses around those key themes. And so my division, Market Platforms, is going to focus on liquidity. And that's around market modernization and the transformation of financial services. Nelson has the privilege of leading Capital Access Platforms that's going to focus on transparency. And that's about really the solutions that are driving insights and intelligence for corporates and investors. And the last one we have being led by Brennan Brothers, which is our anti-financial crime unit, is all about integrity and the integrity of the market. So we think about the protection, the safety, and the integrity of the financial system, because that drives adoption and growth. And so we're thinking these 3 themes are going to accelerate our growth going forward.
Nelson, if one is an investor in Nasdaq out there, they see this new structure stood up, how does your day-to-day change and what will you be working on?
Well, I think hopefully the structure for our investors makes it a bit more clear what we're going after, these mega trends that Tal highlighted, that is really on anti-financial crime. It's where the modernizing the markets. Then in my group, it's how do you provide more data and insights to both investors and corporates. So I think our vision is a lot clearer today in terms of what we're going after. And then also from a customer standpoint, I think that was a big focus here. How do customers want to work with Nasdaq? And we thought combining these business units into divisions makes it a bit clearer to customers. And the last piece is a ton of time on employees. So this does give us a lot of opportunity to think about employee growth, how they're going to think about Nasdaq as a place to work for a long period of time.
I imagine there's a big discussion of AI. You look outside, there was, I believe, AI on a listing recently or today at the Nasdaq. I'll put it to you, Tal. How does AI change your business? How will it modernize your business moving forward?
Yeah, so Nasdaq's been employing AI for quite some time across all of our different divisions. And so we see application across my division, Nelson's division, and anti-financial crime. I'll start with anti-financial crime. Verafin's business is being powered by AI. So they have this network, all this data they're taking advantage of, and it's context aware to help their clients detect fraud. So that's really powerful, drives a lot of value. In my business for Market Platforms, we're looking at AI in the following ways. One is we just put in place something called a dynamic strike program. So we're trying to be really intelligent about capacity management so that our clients can benefit from that. So things that we can take out of the market because they're just taking up capacity without adding value allows us to do 2 things. One is ensure the resilience of the market, but 2, when we put out new product, we've developed more capacity for that product by taking out products that are not as valuable and don't really drive the resilience we want to see in a market.
Does AI make the markets riskier? Because it's run by machines and that requires certain inputs?
Yeah, so we've been really thoughtful about that, thought about that a lot. So we want to make sure that whenever we put out AI or anything that's really context aware or dynamic, we're doing the right amount of testing, we're putting guardrails in place, and we're working with our clients really, really closely, as well as our regulators, to understand the impact it could have on markets, especially if it's a real-time application, because that is a different set of circumstances versus something that might be looking at historical data.
Nelson, you were still leading the listings business?
Yes, I am.
Okay, so in terms of listings, what do you see in terms of AI listings over the next year? Are there a lot of these companies calling you up saying, we're going to come to market, there's a lot of chatter, a lot of hotness around this space? How do you see it?
I think the hotness today is much more in the VC community. So if you were going out to the Valley or really the global VC area, there's a lot of money going into AI, because if you think about the applicability, it is seen as something that across all industries is going to be transformative. So I think more there than saying, hey, I'm ready to go public next year. Now there's certainly some that have been around for a while now that are thinking about that, but this new wave, this new enthusiasm is probably a little more dated than that.
Got about 25 seconds left. I'll leave it on this. Tal, best leadership advice you ever got, considering you are now in this role?
Adaptability and flexibility. You need to be adaptable and flexible, and that's the organization we're trying to draw. The agility is key to our success going forward.
Nelson?
How about we'll go with client listening. So our big theme is around what makes sense for clients, where do they want us to go, And we think what we develop here in this structure is where they want us to go. So we're excited about how to listen to our clients.
All right, well, congrats on these promotions. Tal Cohen, good to see you. Nelson Grace, good to see you as well. Julie, Brad, back to you.
Thanks so much, Saz. Appreciate it. We'll be right back with a discussion on housing.
The latest minutes from the Federal Reserve says economists believe that the banking turmoil will trigger a mild recession later this year. But does that mean that you should put the search for your dream home on hold? Joining now to weigh in on the considerations home buyers are making in today's market, we've got Columbia Business School's Paul Milstein, who is the professor of real estate, and Christopher Mayer, thanks so much for taking the time here today. First and foremost, Chris, what should people be remembering when they are looking at the environment right now, looking at the Fed's policy pathway and hearing what bank execs are saying, while at the same time just saying, look, guys, I'm just trying to buy a home. I'm just looking for the spot of my dreams.
Look, as far as I'm concerned, I think they should first focus on let's buy a home and how to think about it. But I will say that the economic environment is a very tough environment. When I was on here about a year and a half ago, I think my kind of headline quote was, now might be one of the worst times to buy a home in the coming year that there has been in a long time. And I still think it's a pretty tough time to buy a home right now. It's the macro environment is tough, but there's also just not a lot on the market, and there's probably not going to be a lot on the market coming, for quite some time.
Let's talk about that quite some time for a moment, Chris. It's Julie here, because are we talking about potentially a generation in Gen Z that will never buy their own home, potentially? In a higher proportion than
no, I think sometime is kind of a year or 2, 3 years. Lifetime is a little bit longer. But I will say that for a long time we've seen the home ownership rate declining in this country. If you look at sort of young people, we're talking decades, not just a Gen Z issue. And that's really been driven by challenges. Wages at the bottom in the middle of the income distribution haven't been keeping up with, the housing market and even with the cost of living. And so it's gotten tougher for many people to be in a financial position to buy a home. And credit has never really recovered from where it was, not just in 2005 and 6, but even in the early 2000s. Credit has continued to be tighter to buy a home, going forward. So times have been challenging for those folks. I think for the Gen Z people that are looking and saying, are we, thinking about buying a home at some point, which includes my kids at some level, I think the answer is yes, they will be able to do so. But, a lot of the houses, right now with interest rates having fallen so much during the, 2000 to 2020, 2021, a lot of people who owned homes refinance mortgages. And there are a lot of people out there sitting with 2 3/4, 3.25% mortgages. And those people are just not going to be anxious to sell their homes in an environment where the new home they have to buy, that trade-up home, is going to be, at an interest rate of 6.5 or 7, even at 6. So a lot of those folks are going to say, look, I'm going to renovate. I'm going to kind of stay in the home. So that's the sense that there just aren't, a lot of the homes that would have been traditional starter homes, I think people are going to be staying in longer. And so I think that's going to open up the market for home builders and new construction in a way to make the case to people to try and trade up a little bit. And I think home builders may also want to start to kind of move, down market a little bit and try and build more of the kind of housing that first-time home buyers would want to get. So some of this really is a supply issue as much as a demand issue.
Yeah, I mean, I'm telling you, my searches have really changed from Toll Brothers homes to now just cars that have a good frunk. So at the end of the day, I mean, the search patterns have changed. The prices that we're looking to pay have changed so drastically. Have the credit scoring practices changed enough to really keep up with all of the different payments that we make, to give a better sense of the payments that we are able to make on a timely manner, to give us kind of a better shot at getting approved for a loan, even when we're going for something as large and as equitable as a home purchase?
Yeah. So I will sort of say one of the big focuses of the Biden administration from a housing policy is to try and open up access to home buying, to look at alternative measures of credit for people who may not be fully participating in the traditional housing finance system, but make their rent payments on time and have made their rent payments on time for years. And so there has been a big push to create alternative credit scores that are ways to broaden access to credit to, traditionally disadvantaged groups of people. And that's been a very important focus. I think we've seen some action there, and we're going to see more, both at FHA, VA, and at FHFA, Fannie and Freddie. So I think there is a push to broaden access to credit, to have alternative ways to look at that for folks, because it is, for some people, I think there are people who historically would have been able to buy a home, but the tighter measures of credit that people are looking at now are saying, gee, we're going to make it harder for you. And I think those are people who could and should buy homes, were able to sustain home ownership historically. And, we got to a home ownership rate in this country of 69%. And that was a good thing, not a bad thing. And lots of those people were able to continue to make their payments, and we should be able to provide a broader amount of credit into the market.
And just quickly, Chris, for those who are not, aside from home buying for a minute, if somebody wants to invest in real estate, and I know that's a big bucket right now, what's the best way to do it? Is it buying home builder stocks? Is it buying fractional, multifamily? What do you think?
I think if you're looking at investing in real estate right now, I would start with real estate investment trusts. They've been beat up a lot. You can buy, shares of office REITs or apartment REITs, even, to some extent, single family, where, particularly office and apartment, where you're able to buy at very significant discounts to the market. I think the buy to rent is a tough business, and you've seen institutions pull out of buying new properties, and the iBuyers have bought out, because it's sort of a lethal combination of home prices that are very sticky on the high side, rents where there's pressure to start falling a little bit, and very expensive credit. And the combination of those three things doesn't make it great for sort of buying with an investment horizon. At the moment, it works if you're trying to live in the home over a longer period of time, but it's a tough market for investors. And I've never been a big fan of fractional ownership other than of vacation homes, where I think there's a thesis there. But, selling a fraction, buying a fraction of your home, having somebody co-invest with you, unless it's a relative, go focus on trying to get an FHA loan. Those are available, buy the home, save a little bit for a down payment. The traditional way of buying a home is still the best way to do it. The fractional things are often expensive and not great deals for consumers, who are buying a home to live in it, or, rent to own. Those business models are more expensive than just doing the things the old fashioned way.
Christopher Mayer, who is the Columbia University professor, joining us here today to talk all things home. I will let you know when I upgrade my searches from cars with good fronts to perhaps at least a shipping container home. Chris, appreciate the time.
Excellent. Great talking with you, and good luck.
Likewise. Thank you. Coming up, gas prices, they're rising again. So how should you plan for your summer road trips? We've got everything you need to know on the other side. Buckle up. Gas prices are on the rise again and are expected to go even higher this summer. With the current average gas price up over 20 cents just in the past month, will drivers be able to catch a break soon? Let's bring in AAA Northeast Senior Manager Robert Sinclair Jr. to discuss. Always a pleasure to get some of your insights. All right, tee up the summer travel season for us. Is there any reprieve in sight?
Maybe not in the short term. We're seeing the effects of the summer blends of gasoline, which are more complicated to refine and distribute, sending prices higher, up 25 cents per gallon in just the last month. Prices generally top out sometime in May, June, or July. So we might be seeing that coming up soon. But I think demand is going to be the one thing that can affect prices either going higher or lower, particularly with demand in China coming back. Some analysts are saying that because of that, there's going to be a 2 million barrel per day increase in demand. But American drivers don't like higher gasoline prices. I think back to a survey that we did back in March of 2018, asking drivers what the pain point was for the price of gasoline. And back then, during a better economy, 40% said $3 a gallon. We're at $3.68 now. So I think there'll be some pullback as far as demand, and we're seeing that at least in the short term. So it remains to be seen. It's a very, very fickle market, and things can play into prices going higher or lower very quickly and very easily.
And Robert, on the demand front as well, we've been talking this week about air demand, airline travel demand, which seems to be pretty robust. People are still getting out there and traveling. Are there any implications for driving vacation demand also. Are we still in this sort of, I don't want to call it revenge travel anymore, right? But it does feel like there is this desire for people to get out there, which implies there are going to be a lot of cars on the road.
Yes, and AAA is one of the largest leisure travel agencies in the country, and we're seeing robust demand for air travel, particularly international travel, people going to Europe, Mexico, and the Caribbean. 90% roughly of summer vacation trips are made via the motor vehicle. So I think there's still that pent-up desire. People are still going to want to travel and drive to their destinations. The higher gasoline prices might play into the fact that they shorten the distance of the trip or the stay at their destinations, or maybe cut back on the activities at their destination. But it's just something, it's the American rite of passage to take that road trip every summer. So I think it will happen, but there might be some pullback. It really depends on where prices are going. We're a lot cheaper than where we were last year. We got up over $5 a gallon last June 14th. We're not there, but our surveys that we revisited last March said that drivers don't like gasoline. 60% of drivers don't like $4 a gallon gasoline, and 75% don't like $5 gasoline. And we're getting up there. So a lot remains to be seen what's going to happen.
How far are we away from electric vehicles being part of the great road trip for the summer?
Probably a little bit far away. There are 177,000 gasoline stations in the United States, about 109,000 electric charging stations. But it takes 2 minutes to fill up your gasoline vehicle, and it takes 20 minutes to get a good charge into an electric vehicle. So that's 10 times longer. So maybe we need 10 times the number of charging stations. And the Infrastructure Investment and Jobs Act has put aside $5 billion for 500,000 additional charges. So that'll get us up to about 600,000. So that would help, but that's going to take time. Also, we're seeing at any given moment, maybe 10 to 20% of electric charges that are out of service, either because of vandalism or because of equipment problems. Vandals are stealing the wires from electric chargers and selling them for scrap. So the Great American Road Trip by an electric vehicle is difficult to do. It can be done. I know people who have done it, but it takes a lot of planning and it takes more time. We're still going to rely on the gasoline engine vehicle for a while. It's got miles to go before it sleeps.
Yes, indeed. Really interesting there. Interesting point on theft of different parts of those charging stations.
Yeah.
I want to talk to you much more about that, but we'll have to bring you back to do it. Robert Sinclair, thanks so much. AAA Northeast Senior Manager. It's always good to get some of your time.
Thanks very much for having me.
Thanks. Well, Teladoc is set to close this week higher just a smidge after the company announced patients on the platform will now have access to prescription weight management drugs. This news coming after a week after Weight Watchers' foray into prescription weight loss sent shares soaring. Our markets reporter Josh Schaefer has been looking into why Wall Street has such a growing interest, hunger, if you will, even for this. I mean, obesity control drugs have exploded, but the difference is that people are using them recreationally, I guess, so to speak.
Right, yeah, it's spreading, right? And I think overall that's sort of what people are getting into here. And really what I talked to some folks about is the access that a company like Teladoc or what Weight Watchers bought can provide by being remote, right? So this is remote offerings to be able to offer these products. There's sort of good and bads to that. There's the positive of there is not a lot of obesity care in this country diversified throughout the nation when you think about near in a proximity to you. So it's a positive there. The negative is how people use it, of course. Right now, what you're looking at is from Goldman Sachs, and it's showing the overall growth of Ozempic, which is one of those pills made by Novo Nordisk. And you've seen that pretty much triple over the last about year and a half now. And then the bottom blue line there is Wegovy, which is also growing. But really why Wall Street's so interested in it is another graph from Goldman that shows the overall size of this market and sort of what they're expecting over the next 10 years. They're expecting Novo Nordisk probably had, I think Wegovy's annual revenue in 2022 was about $2.5 billion. They're expecting that to grow to $10 billion. So about 4 times what it is now in the next 10 years. And so this is an opportunity for a company like Weight Watchers or a company like Teladoc, who aren't making these drugs, to be clear, right? They're just gonna be able to distribute them through care, but to be able to distribute those and get in on that growing market that is this weight loss drug market. And I think the FDA has only cleared some of these drugs. So Eli Lilly's drug is not yet cleared, but they are also trying to get in that market. And that was the biggest part of that graph from Goldman. Goldman thinks Eli Lilly could be the ultimate winner here with that drug, Mounjaro, that has not yet been cleared by the FDA for weight loss.
Part of this is tied to TikTok trends too that we're also seeing. So how much of that is making its way into the discussion, both for a safety element, but also as being cited by some of the investors out there?
Yeah, Brad. So I talked to Dr. Scott Kahana, director at the National Center for Weight and Wellness. And one thing he pointed to was the overall publicity and what this has brought. He said more people are asking him about these drugs now than 2 years ago. And Ozempic's been around since 2017. Again, Ozempic is primarily a diabetes drug, but it's been around since 2017. Now he's getting asked a lot more about that. They're getting asked a lot more about Wegovy, which was cleared by the FDA in 2021 and cited by our friend Elon Musk in 2022 as why he thinks he's been able to stay so fit. And he said that those billionaires being interested and Wall Street being interested, of course, Mr. Musk tweeting, but that has drawn some interest to the drugs.
I mean, I don't want to fat shame anybody, but we need another shirtless yacht picture of him because I'm not seeing the receipts for that one. But anyway, we're going to leave that there. Josh, thanks so much, Josh Shaver. Sorry. All right, let's get a check of maybe you should check markets, Brad.
Taking a look at the major averages, we're down across the board, ladies and gents, boys and girls. In the red, Dow down 0.25%, about the same on a percentage basis. For the S&P 500, that's down by about 0.25%. And Nasdaq 100 lower by about 0.4%. We've come a long way since good morning. Everyone, coming up on the other side of this, Rochelle Akupo has you for the next hour of trading on this Friday. We'll be back same time, same place on Monday. Here's a live shot of New York.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Score draw. It's a stalemate for bulls and bears alike as markets lack direction after a noisy week of corporate results. Fed speak offers some clues on the policy ahead of a blackout period. We'll cross it all for you. And the data doesn't lie. Economic reports suggest the slowdown is here, but will it be as bad as we've anticipated? We'll ask Templeton Investments how to best position in recessionary times. And the road to net zero. Proxy season has seen anti-ESG proposals jumping. So has the space lost its luster? We'll speak with David Callahan on where philanthropy and investing could meet in the future. But first, let's get a pulse on how the major indices are faring. We're still seeing some selling action across the board there, but still relatively flat though. The Dow there down about 0.25% there, the Dow being buoyed a little bit at least by Procter Gamble's earnings. The S&P 500 there also down 0.25%. Tech and materials, some of the weaker sectors this morning, and the tech-heavy Nasdaq also under pressure there, down 0.25% there. Amazon, one of the few bright spots in there. Let's also check in on the Treasury market as we round out the week. We see that for the shorter term yields, we're seeing gains there of about 0.5%. Similar story for the 10-year, one most sensitive when we hear from the Fed. That's also up about 0.5%. And the 30-year, longer term yields in similar territory there, up about 0.5% as well. Well, the economic slowdown we've been talking about for months now might finally be here. But what does it look like? And is it worse than we first thought? Joining us now to discuss is Yahoo Finance's Diane King-Hall. Good to see you, Diane. What are you watching?
It's good to be with you, Rochelle. Well, we've been talking about the dreaded economic slowdown, or dare we say it, the R word, recession, for eons now, it seems. But is the data suggesting we're already there? So first things first, results season, earnings. The last few days have given us indications corporate America might not be on the best footing. JP Morgan Chase got us off to a flying start with numbers that defied even the most bullish expectations. But it's a tale of two banks, with Goldman telling us a different story. It missed on the top line due to a slowdown in trading revenue. On the consumer side, American Express definitely provided food for thought, seeing record revenue, but with worrying signs on consumer credit. Then Tesla yesterday, price cuts not helping its bottom line. Today, announcing price hikes for certain models. Reversal there. The announcement on price hikes coming after that stock took a hit. Now, from the ground to the skies, airlines also in focus. Bullish demand forecast from United, despite net loss, but a disappointing outlook from American, definitely weighing on sentiment in that sector. Finally, an area we shouldn't lose focus on, transport. CSX beat the street, but a different story for Knight Swift and W.R. Berkley. On the economic data front, we've seen weakness persist. Higher weekly jobless claims on Thursday stands out among that crowd. Loosening a tight labor market remains a key focus for the Federal Reserve. Now, adding to the doom and gloom, the leading economic indicators index dropped to its lowest level since November 2020. And data from the Association of Individual Investors, meaning Main Street, showing pessimism for the 69th week in 74. And finally, fresh data out yesterday on emergency loan data shows stress in the banking sector. That strain isn't going away and continuing to muddy the waters there. So, Rochelle, there's definitely some stress out there that we're seeing.
Indeed, explain some of the tentativeness we're seeing in markets this week. Great
That's
stuff
right.
there. Thank you so much, Diane.
You got it.
All right, covering your bases. Procter Gamble might be betting consumers will spend even more as they buy less, but it's hedging its bets with a focus on private label goods as the economy sours. Yahoo Finance's Brian Sozzi spoke with Procter & Gamble CEO John Mueller. Here's what he had to say. Take a listen.
We've ensured that we're present in a relevant way in the channels that typically benefit from any kind of a downturn. But, you know, in terms of this being a major descriptor of the environment today, that's not what we're seeing. If you look at private label shares as a proxy of trade down in our categories, they're up very modestly, 0.2 points in the U.S. past 3, 6, and 12 months.
So let's talk about how consumer staples are positioning themselves. Joining us now is Olivia Tong, Raymond James Managing Director and Senior Research Analyst. Good to see you, Olivia. So as we take a deeper dive into P&G's performance this quarter, I mean, you have the top and bottom line beat, organic sales really surprising the street here, and then this improved revenue forecast. So as you're trying to sort of get a handle on how the consumer is changing at this point of the year, where do things stand?
Yeah, thanks. Thanks so much, Rochelle. Great to be here. I agree with you. Excuse me. Organic sales were better than we had expected. They were up 7% year over year for the quarter, and they raised the full year guide. And what was really interesting is that while volume was still down 3%, that was better than last quarter, and price contributed 10%, which was the same as last quarter. So price is holding, and yet volume is actually, the volume declines that we've been seeing are decelerating. So, and volume was up in the US is something that was really interesting. And a couple of other things, China picked up too. China was up 2%. So you are starting to see that come back. And that has led to, the sales upside helped gross margins as well, which led to operating margin improvement as well.
And as we try and decide sort of whether or not P&G is a bellwether here, I mean, it does have some of its premium brands on the more expensive side, raising prices year over year 10%, which did offset at least some of what they saw with that 3% loss in volume. But you have an outperform rating on P&G. How are you viewing them in light of the macro pressures and how well positioned they are?
This is a great question, because I think this goes back to a couple of years ago where they did do a lot of things with respect to the portfolio, divesting a couple of brands, really focusing on their 10 core categories, and then also tiering the portfolio a little bit better. So if you think about laundry detergent, you've got Tide Pods at the high end, you've got regular Tide in the middle, and then they have Tide Simply, which is a more gently priced alternative. So as you think about the consumer potentially seeing a little bit greater pull on the wallet and what have you, there are alternatives if they need them. I think the overall performance for P&G also bodes well for the consumer, considering pretty moderate trade down. You mentioned John Mueller, the CEO, saying that private labels only gained about 20 basis points of share, which is pretty de minimis. And that's for a major consumer bellwether. So the consumer seems to be holding quite strong within these categories.
Now, as we look at some of the other consumer product companies that you cover, I mean, you have an outperform on Clorox. You also have on Colgate-Palmolive a market perform. So talk about how they would be positioned compared to Procter & Gamble, given their business units.
Sure. I think with respect to Procter versus Colgate, Procter does have a wider portfolio, a lot more brands, 10 categories that they're in. Whereas Colgate is more oral care, pet care, and then some in home and personal as well. So you definitely have a wider range of brands within P&G. The other thing is the exposure to China is much higher at P&G relative to Colgate. So we think that is an area where you should start to see recovery as time progresses, and that'll help there. With respect to Clorox, where we have an outperform, this is very much about the turnaround. Their gross margins were hit pretty dramatically during the pandemic. They are starting to improve again here. A little bit of concern around the top line and their private label exposure, but generally think that their margins should continue to see nice improvement.
We'll definitely continue to track how they stack up. A big thank you there for joining us this morning. Olivia Tong, Raymond James Managing Director and Senior Research Analyst. Thank you for your time and have a great weekend. All right, time now for our trending ticker. Analysts seeing CSX on track. The transportation company rising on an earnings per share beat and its revenue rising from multimodal transportation and its coal businesses. Among the flurry of market moves, TD Cowen raising its price target to $37 per share. RBC and BMO raising their price targets by $1 each to $33 and $37 respectively. The stock they're up, as you can see, more than 3% so far. All right, coming up, cramming it in. It was Fed speak galore yesterday ahead of the blackout. Did we move the dial on rates at all, though? We'll take a closer look next. The Fed had lots of commentary to pack in before that blackout period began, and boy, did they do exactly that. Notorious hawk Loretta Mester says she favors getting rates above 5%, saying inflation is still too high. She spoke with Yahoo Finance exclusively.
I do think that given where inflation is, and given how stubborn it is, and given the strength, the still strong labor market, I do think that rates are going to have to move up to above that 5% level. But how much they have to move up and for how long they'll have to remain there, that's what the economy is going to tell us. The economic developments, financial developments, those developments are going to inform, right, the future path of policy.
The Atlanta Fed's Raphael Bostic, a voice markets seem to listen to more and more these days, says he still backs a one-and-done rate hike approach. The Philly Fed's Patrick Harker expects some additional tightening may be needed, and Bank of New York President John Williams adding to the hawkish vibes, saying inflation is still too high and the Fed will act to lower it. With that in mind, that's the view from the Fed. But what about the economy? Clearly on the path to a slowdown. How do you position for the months ahead? Our next guest sees cash and fixed income outperforming stocks over the next 12 months. Joining us for the conversation is Wiley Tollett, Franklin Templeton Investment Solutions Chief Investment Officer. Good to have you on the show here. Templeton sees a 60% probability of a recession in the next year. Now that's down from a few months ago. What shifted for you?
Yeah, that's right. We were closer to 65, 70% just a few months ago, but we've seen sort of unexpected strength in the consumer, particularly in the US, coming back in Europe as well. China's reopening. So we've lowered the probability, but still our base case that we expect a recession in the next 12 months.
And I do want to ask you about, in terms of people looking for equity returns in 2023, sort of looking at valuations, but then also looking at earnings, how should they be looking at each aspect of this to really sort of guide them for the year ahead?
Yeah, it's a great question. And going into where sort of the markets are right now, what we see over the next 12 months, as you mentioned in the opening, really cash and fixed income outperforming stocks over the next 12 months. That's an unusual circumstance. Stocks usually pay you to tolerate volatility. But we're not going into a recession. As I mentioned, we've got that as our base case. So stocks right now are really positioned for a very sanguine type of economy. And we just don't see that, particularly sort of those top 6, 7, 8 names, sort of those new staples names that we've heard so much about. They've really driven the market and supported the market up to this point. So we see the opportunity for multiple expansion to be pretty limited over the next 12 months. In addition, what we're also seeing is a large dispersion in analyst estimates around earnings. So whenever you see a large dispersion and disagreement, that's a good signal that perhaps earnings are due to adjust. For example, on the sell side, like when MSCI added up all the bottom-up estimates, they actually had earnings up 18% over the next 12 months. IBES had them up, 4, 5, 6%. Bloomberg down 1%, and we're actually closer to down 6, 7% over the next 12 months. It's very difficult for stocks to climb in that type of environment when earnings really are in a recession.
Indeed, we'll have to be tracking that as well. A big thank you to our guest, Wiley Tollett there, Franklin Templeton Investment, for joining us this morning. All right, stay with us. We're taking a look at chips. The chip makers, semiconductors, have been labeled the new oil. But is the direction of travel higher for this critical industry? We'll discuss next. Two companies that make specialized equipment for manufacturing computer chips are calling for a boom in sales to China later this year. That forecast comes despite US export restrictions on the latest chip-making technologies. Meanwhile, the US is working to develop its chip-making infrastructure. For more on the current direction of the semiconductor industry, let's get to Yahoo Finance's Ines Ferre. Hey, Ines.
Hey, Rochelle. Yeah, and those two companies, well-known companies when it comes to manufacturing of semiconductors or the equipment to manufacture semiconductors are Lam Research, that's based out of California, and also ASML Holdings, and that's based out of the Netherlands. So they're both expecting strong demand coming out of China. Now, the U.S. last year had announced that it was imposing some restrictions on exports into China of certain chips and also manufacturing tools for those chips. But that involves the more advanced chips. So you still see chips that are going into the EV vehicles, for example. The demand for those are growing in China. And those are the types of chips that we're talking about when it comes to the Chinese customers for ASML and for Lam, when it comes to that strong demand that they are seeing that will continue out of China. So Lam and ASML say that these Chinese customers are buying tools for building the less advanced chips, those chips that go into EVs, those chips that go into mobile phones, that also go into laptops. And this is all happening really when you are seeing each region of the world, or the major regions of the world, trying to become more self-sufficient when it comes to making chips because of the supply chain issues that we saw during the pandemic, and also because of security concerns as well. So Europe just approved an EU Chips Act that's aimed at building capacity for building chips out of the EU, also making the EU just basically more self-sufficient and trying to avoid those supply chain issues that I just mentioned. As far as where the chip sector is going, analysts are seeing a recovery in the second half of 2023 after an inventory digestion. And you just had a Jefferies analyst that have a buy rating on Lam saying investors are underestimating the potential for a V-shaped recovery, which is often what happens after a material inventory correction, Rochelle.
And then also honing in on TSMC, what do their latest results say about the chip space?
Yeah, basically what they are, they revised down their full year sales outlook. So they're expecting their revenue to be a little bit lower, but nevertheless, their CapEx is remaining unchanged. So that's a capital expenditure. And so that bodes well for the equipment makers of the chip makers. So when you're taking a look at the overall sort of health of the industry, they do see that a stronger second half of the year, which kind of jives with what analysts are also saying. They're seeing a second stronger half for the year, so they're expecting even stronger 2024, Rochelle.
Well, thank you for getting us up to speed on that, our very own Ines Ferre. Well, Silicon Valley Bank's collapse and the resulting banking crisis dealt a major blow to mergers and acquisitions, as well as the capital raising environment, especially for the tech sector. However, there is one sector that's still speeding up. Yahoo Finance's Ali Garfinkel has those details for us. Ali, what are you watching?
Hi, Rochelle. So there is one sector that is popping, and that is data information and analytics. That's according to a recent report that we've seen from Solomon Partners. And data information analytics, not a sector we're used to seeing its name in lights in any capacity, but it is nevertheless something that has proven to be important in the aftermath of the collapse of SVB. So it's something that we're seeing investment in despite M&A being down across the board. Now, I want to run some of these numbers by you. First things first, these data information analytics deals increased from 16 transactions in Q4 of last year to 35 in Q1 of this year. So that is more than a double. And then that's also been true as M&A volume across the board has declined. I believe we've seen a 14% decline in M&A volume across the board. Information data companies are also seeing good capital raises. It's something that, across the board, again, we're also seeing a decline. But for these information and data companies, the capital raises have gone from 10 transactions in Q4 to 17 in Q1. Now, I want to give you a represented deal because I say information data analytics companies. Actually, what I'm talking about are a lot of Yahoo Finance style competitors, right? You've got the Moody's of the world, the Bloombergs of the world, but it's also, I want to give you a representative deal here because I think it actually throws some clarity on what we're talking about. The representative deal was the FT, SGX, and Wilshire deal. Now, if you're not familiar with Wilshire, what they do is they build investment products, they build data products. And they actually did a corporate carve out that created Wilshire indexes in conjunction with the FT. Now, if this all sounds really wonky so far, that's because it is. The days of what our head of news, Miles, would call ticker on ticker action, where one big company you've heard of is buying another big company you've heard of for a major price tag, that's not really happening right now. Point blank. And the truth is, the why is pretty simple. It ties back to that collapse of SVB, and it does tie back to the economic uncertainty that we've seen boiling and building over the last year and a half as well.
So then if you compare some of the concerns that we saw at the beginning when the collapse was first happening, what's the way forward now then for the VC landscape?
It's really hard, Rochelle, to determine exactly what the way forward is. But the thing I've heard time and time again is end of the year. That's when we're going to see deal activity across the board really pick up. That said, deals aren't happening because there's no capital. There is, in fact, actually record amounts of capital, record amounts of dry powder just sitting there. I believe we'll get a graph across the screen soon. Yes, here we go. We're actually record numbers of dry powder. We're not quite at where we were in 2021, but we are pretty much there. Now, I've actually been critical on this show before. I've been concerned about dry powder staying locked up the way it has when founders, frankly, have been in really dire straits, especially in the aftermath of the collapse of SVB. But this report actually did really clarify something for me, Rochelle. And it looks, here we go, exactly. U.S. sponsor fundraising activity. So if you look at that, 2022, it was down massively. We're talking about the LPs, for instance, who are investing in VCs or private equity firms. They are not as willing to part with their capital right now. So it begs some questions about the long-term implications for these VC firms and these investors. I would say they have powder in the short term, definitely, and those concerns about the long term are very clear to me. And I think the truth is, the way forward, we look to the end of this year and see where things are at. And to me, this really does, in the end, bring into sharp relief the really tough spot that tech M&A and a lot of M&A at large is still in.
Indeed, certainly see them being a lot more strategic here, not just sort of splashing the cash about. Ali Garfinkel, thank you there for that update. All right, coming up, Rystad Energy says companies are planning bigger offshore oil investment in the coming years. So what does that mean for the likes of, say, Halliburton and SLB? We'll take a closer look next. Turning now to the business of energy. Taking a look here last week, the IEA said world oil demand will climb by 2 million barrels a day in 2023 to a record 101.9 million barrels a day. Now, that kind of demand would be great news for the oil majors and the businesses that provide the tools for them to operate. There are other positive signs. Rystad Energy says companies are planning bigger offshore investment in the coming years. Now to SLB, formerly known as Schlumberger. It beat the street with its latest results while seeing a positive outlook for the months ahead. Joining us now is Catherine Olexa, Morningstar Energy Equity Analyst. So I first want to start with SLB here and talk about the rating that you have on it at the moment and the sort of expectations that you have for the outlook now.
Sure. So we expect 2023 is going to be pretty strong for SLB. They had a really great end to 2022, and we've seen a little bit of weakness this quarter just due to some seasonal reductions in activity in several of their regional end markets. But we expect that that's going to kind of come back starting this quarter and beyond. We basically estimate about top line growth around 18% year over year for 2023. And then we expect that to average about 10% over the next 5 years or so. So pretty strong runway for growth moving forward. And then in terms of profitability, we expect that it'll improve a little bit this year as well. We're expecting about 24% adjusted EBITDA margins for 2023, and then expected to sort of remain there moving forward.
And I understand you have an equivalent rating system here. Break that down for people who are trying to sort of follow along so they can see the opportunities.
Certainly. So the Morningstar star rating, basically 3 stars is going to be a neutral or a hold rating. And then anything that's 1 to 2 stars is equivalent to a sell recommendation. And 4 to 5 stars is going to be equivalent to a buy recommendation. So right now we have SLB at a $56 fair value estimate, which places it around 3-star territory today.
So for people who want to invest in this space, I mean, you have the individual oil companies and then you have sort of the refiners, you have the other elements in it. As you look across the supply chain there, where do you see the biggest opportunities in the next 3 to 6 months?
So for SLB specifically, offshore is going to be a really strong end market for them. They have some pretty decent exposure in that space, just in terms of subsea equipment, and then more general like well construction services that they provide. That's going to be a really strong avenue of growth for them over the next several years, even into 2025 and beyond. The second area for them that will be particularly strong this year and already has been demonstrating some pretty great results is in the Middle East. And management on their call today actually indicated that they could see record revenues from the Middle East this year. Right now, that region represents a little bit under 1/3 of their overall revenue. So those are 2 really big bright spots for Schlumberger and the industry as a whole in 2023 and beyond.
And so as we broaden it out to look at the broader industry, I mean, there's a lot of expectations here, but looking at the oil prices, you have what might happen when China comes into full flow with demand as well. And that's really a harder one to gauge, and sort of any other geopolitical issues that might come up, and also sort of currency pressures, what the central banks are doing. How should people be investing in this space if they're trying to perhaps be a little bit defensive and sort of avoid some of the risks here when you do have such fluctuations?
Yeah, so I would say it's probably tough to invest in the commodity space if you're wanting to pursue a more defensive strategy. But, you know, for Schlumberger moving forward, SLB, I think it's going to be, I think their main driver to pay attention to is going to be overall industry capital expenditures rather than some of these more near-term geopolitical developments and things like that. Because once SLB locks in these contracts, for the most part, that revenue is going to be pretty much secured for the year. Obviously, that might lead to further disruption a little bit further down the road. But in terms of the next 3 to 6 months, I think that it's going to be a pretty solid performance for them, just because we'll have some of those the adverse impacts from seasonal operations and weather, things like that, are going to sort of alleviate in the second and third quarter, which will provide some pretty solid runway for better performance in the near term, as well as just overall elevated industry activity and investment.
Well, thank you so much. We do appreciate getting that outlook out there for us. Catherine Alexa, Morningstar Energy Equity Analyst. Thank you for joining us this morning. All right, coming up, the backlash against ESG was one of the stories of 2022. So are we still investing in a better future, or has capital drained out of the space? We talk sustainability next. ESG was once the acronym on everyone's lips. Now it's something of a grey area amid an ongoing backlash. The conference board weighed in on the issue ahead of proxy season, saying companies should, quote, be prepared. According to the Sustainable Investments Institute, investors have filed 68 anti-ESG proposals this year. So is this just a reset after an overcorrection or the beginning of the end? Let's talk about the intersection between sustainability and finance. Joining us now, David Calloway, editor and founder of Calloway Climate Insights. Good to have you, David. So, I mean, we really did see some of this. Good to see you. We really did see some of this investment and this anti-ESG sentiment really hit a peak when it came to the lows that we saw last year in terms of companies investing. Where are we now in the conversation when it comes to ESG and climate investment risk?
Well, unfortunately, Rochelle, for those of us who favor investment sustainability, the anti-ESG sentiment is alive and strong, probably growing stronger as we get closer to political season and specifically the election next year. The good news is that it's more of a political talking point now that some of the red state legislatures have made it a cultural war, if you will, against wokeism in the U.S. It's more of a political thing than an investment thing. Most of the investment managers are a little worried about it. They obviously don't like to be in the negative limelight, and they've pulled back some of their ESG marketing, but it's not really affecting the principles of ESG investing, which is to watch out for climate risk. So I think you're going to end up seeing a backlash start to grow in some of the red states like Texas and Oklahoma and even Florida by fund managers who want the freedom to counter climate risk in their portfolios. So you'll start to see that grow in the legislatures of those states, despite the fact that the politicians are leading the charge.
And it's interesting because obviously we know from Larry Fink and his approach to this, and then most recently we saw less mention of sort of ESG investing, still saw some mention about climate risk. He said, it's been 2 years since I wrote that climate risk is investment risk. And in that short period, we've seen a tectonic shift of capital. Sustainable investments have now reached $4 trillion. So is it a case of sort of saying one thing, but then actually seeing the investing showing up in ESG, but perhaps instead of sort of labeling it as ESG, climate investment risks that everyone should be really preparing for?
I think what's happening is that ESG as an acronym, it has become sort of a fad even among investment managers. It was always confusing. Environmental, social, and governance investing. You're taking in three very big themes there into one acronym, and they did it for marketing reasons. And I think probably we'll end up seeing the term ESG fade along with some of the past socially responsible investing that we had 10 years ago. And climate investing, accounting for climate risk, accounting for flooding and fires and damage to assets and insurance risk is just going to become mainstream investing of the future. And that's actually good for investors and for investment managers. Why Fink decided to back down on his letter this year is the result of much speculation. He said a couple of weeks before that in Davos that BlackRock took in $400 million in assets last year and lost maybe 10 million to anti-ESG sentiment. So it's really not hurting their business, but his toning down his rhetoric probably reflects that the investment management industry is kind of getting to the end of sort of ESG fad. That doesn't mean that all these stocks and funds behind it are going away. They're doing well and will rebound when the economy does. But the fad itself is probably going away.
Now let's talk about people who want to invest in this space. I mean, a lot of people, when they think, obviously, electric vehicles, you think Tesla. But in your notes, you're talking about that Tesla is, for the first time, defensive at this point. What does this mean then if you're trying to invest in Tesla? What's the mindset you should be having right now?
Well, I mean, it depends what a bigger Tesla fan you are, right? What I was saying in my column yesterday on Callaway Climate Insights is that this is the first time that Tesla in its corporate lifetime has really been on the defensive. It's always been the darling stock, the one going to unimaginable highs. Now it's on the defensive. It's cutting prices. Its profit is shrinking because of that. Other big automakers are joining the electric vehicle craze. And so how Elon Musk handles this, what he does, whether he kind of adopts Tesla into say a services model, focusing on software and electricities, kind of along the lines of what Lou Gerstner did with IBM a few decades ago, or whether he goes for the big innovation play like Steve Jobs did when he transformed Apple with the iPhone and with Apple Music. It's going to be interesting to watch. For investors in electric vehicles, this is really the main touch point. You can invest in wind power and solar power. Even carbon storage removal is starting to become big. But the main touch point for us as consumers is going to be electric vehicles going forward. And Tesla is just one of a growing number of automakers you can invest in. You know, Rivian is out there. They're making their product. Fisker is out there. Lucid Motors is out there. But really, for my money, Rochelle, the big successes are going to come from the major automakers that can scale EVs: Ford, GM, Volkswagen, and Tesla.
And then as you look, you mentioned Tesla, but also some of the other parts of the supply chain as well. Are there companies within the supply chain that really stand out to you as the ones to watch?
Well, there are, there's a lot of supply chain elements, the mining companies, the lithium makers on batteries. We didn't even talk about the charging companies like ChargePoint, for instance, The electric charging companies, that's a fascinating micro industry in the EV story itself. I mean, you're not going to be able to drive these EVs around without an adequate charging network. Who owns that network, or whether it's just a bunch of micro networks, is going to be fascinating going forward. So, investors should look at some of those charging companies, some of the lithium companies, some of the battery companies. I would look at lithium prices are way down this year, so people who want to get in on a bargain may want to look at that as a bottoming out type play. But we're going to see it. It's really going to be a rodeo going forward, and a lot of fun. And I think the ESG stuff we talked about at the beginning of the interview was just the beginning of the craze. And now that the kind of marketing fad is gone, we're going to start to see real stocks and real companies adopt climate and renewable energy into their plans. And we'll see new winners come and lots of losers.
And what about in the media space as well here? Because clearly this goes obviously beyond just some of the traditional that we're seeing, a lot of this media as well.
Well, the media, I'm from the media space, you're from the media space. I used to run USA Today and some other media companies. And I decided a few years ago I was going to dive into this climate story because I really see it being the big story going forward, not just from climate finance, but from how the world is run, what migration story, obviously the weather story. The UN came out this morning saying that last year was one of the worst years ever for climate, and it's going to be even worse this year. Half of Asia right now is under an unbearable heat. So, I really wanted to think of what's going to be the story for the next 20 years. So I jumped on it. And lots of other media companies have followed suit. Pretty much everyone's got a climate beat or a climate newsletter going on right now. So there'll be a shakeout in that as we go forward. There's media constantly reinvents itself. We saw the sad news about BuzzFeed News yesterday. And the climate media will rise and then shake itself out. I think the main story, Rochelle, is climate finance, because that is investing in the solutions behind what's going to help us adapt to climate change going forward.
Indeed. A big thank you for joining us, David Callaway. Callaway, Climate Insights founder and editor-in-chief. Thank you for your time this morning. While industries such as farming and consumer beverages heavily rely on the use of water, the scarcity of this sought-out substance remains to be an issue that extends far and wide. Here with more on water accessibility is Gary White, CEO of Water.org and Water Equity. Thank you so much for joining us this morning. So, a lot of people don't really realize a lot of these huge companies that have a reliance on water sources, for their products and services, but we don't always hear about the communities in the supply chain that actually lead to that growth. Talk about some of the issues that you're seeing in the business community and really connecting those dots between water scarcity and some of these big companies.
Sure. Good morning. Thanks for having me here today. I think what we see is when we look at the climate crisis, it really is a water crisis. And when we hear about climate refugees, really what we're seeing is water refugees because of the scarcity of water that's brought on by climate change. Usually we see that in the form of droughts, but it's also in the form of flooding and wiping out, water resources or contaminating them. And so when you see people competing for water at the same time as corporations are competing for water, especially in some of the low and middle income countries where we focus, there is this need to kind of come together to provide opportunities for corporates and for other water users in those water basins to look at sustainability and equitable access to water. And so we're working a lot with the Water Resilience Coalition right now, which is made up of about 35 companies and growing who are committed to making sure that they are good stewards of water resources and have committed to reaching 300 million people with access to water. And so we're helping them to kind of live this out around to meet their goals.
And as we look at some of the companies that you work with and partner with, Bank of America, IKEA, Stella Artois, Target, even in terms of really making sure that they're providing the communities in India and Bangladesh and other places with, obviously you have to have a healthy workforce in order to be able to do that. But in terms of the business argument, it does seem like Water seems to go on the back burner, especially in light of COVID here. What is the business case here for some of these corporations who are saying, look, why should we be as concerned about this?
Yeah. Well, I think it's, lots of reasons. I mean, first of all, it's just the right thing to do. If you're operating in a water basin that has limited water resources, it makes sense to come together with everybody there to find an equitable way to look at this. But then you look beyond that in terms of we were talking earlier with David about ESG. I think that when we see corporations responding in these ways and collaborating on something so basic to human survival, ESG comes to the fore. And so it makes good business sense from that perspective as well. But at the end of the day, I think we all recognize that everyone on this planet should have equitable access to affordable water. And the more we can do to ensure that for future generations, we should. And the real disturbing part of this is the people that we're trying to help, people living on a few dollars a day, they had the least responsibility for the climate crisis, and yet they're the ones that are going to, feel it the first and feel it the hardest. And so there's a moral imperative with this, along with certainly a good business reason to do it.
So then what should regulators do in terms of when it comes to some of this corporate responsibility for those who really do use the bulk of the resources, but then perhaps aren't the ones who end up dealing with some of the after effects in some of these communities?
Well, I think, from a regulatory perspective, it's shaking out right now in terms of what's happening with ESG and making sure that, it's real and that the positive social impacts associated with our activities are real. And I think there's nothing more real than, helping people who might be spending hours each day or sometimes spending, huge amounts of their income, sometimes 25% of their income, to purchase water from water vendors in slums around the world. And when we see, so many, inequitable ways of having to shoulder this water burden, it just becomes, makes a lot of sense for us to rally behind them and to bring in those users of water. I mean, even agriculture, accounts for over 70% of water use around the world. And so we see that competition between agriculture, manufacturing, and others. But, there are ways to make it all work so that everyone can have what they need and the ability to earn that ESG along the way.
And especially when you think already of inflation on things like food prices, when you add water scarcity into the mix with agriculture, certainly paints a picture that a lot of companies should be prepared for. A big thank you there to Gary White, CEO of Water.org and Water Equity. Well, it's been a slightly muddled reporting season since JP Morgan's blockbuster earnings set the bar sky high last week. So can big tech also ride that tide that lifts all boats? Yahoo Finance's Brad Smith has all the details. Hey, Brad.
Rochelle, well, we have really been looking at this entire earnings season and kind of gotten through the alpha airlines, gotten through the beta banks, but now we get into the gamma and the Google, the Alphabets, the Microsofts, the Metas, and the Apples, of course. That's where we get into deep tech. And so just to really run through some of those mega cap tech names that I just rattled off for you as we begin to get into the throes of what they have to say about the consumer environment for demand on consumer technology, also some of the corporate spending that they're seeing as seen through things like Amazon Web Services, things like Azure, and all of the cloud services that they put forward. I want to kick things off, though, on the advertising front and talk a little meta platforms. As you're seeing over the course of the year to date, they are higher by about 76%, excuse me. It's been a little bit of a bounce back for tech, of course, that we've been tracking. And so Meta, a beneficiary of that. And even as we're going into this next earnings period for them, it's going to be about the guidance and what they're seeing, not only on their own spend, as a lot of the metaverse talk has really kind of fallen by the wayside in this near term, as the focus has really been on where those advertising dollars can continue to pour in for a company like Meta Platforms. They're expected to see earnings per share of $2. Also expecting to see revenue of $27.6 billion. Also important to note, 2.99 million monthly active users is what the street is looking for. That's a consensus Bloomberg estimate there. An average revenue per user of $9.43 there. Also, moving things right along here, let's get to Google here, or Alphabet, whatever you're calling them. Call them higher here on the day. And over the course of the year, they're also up by about 19.5% for Google. Expecting to see adjusted EPS of $1.08 based on consensus estimates there. Revenue, that's expected to come in at $68.9 $9 billion. Now, that number ex-TAC, ex-traffic acquisition costs, which is, of course, the amount that they pay to receive that search traffic as well, that's expected to come in at $56.9 billion. Keeping it chugging here, let's go to Microsoft. They're also reporting next week, and we're going to break down those results on After the Call. Shameless plug there for you folks. In the evening, we're going to be listening closely to see what the execs, Satya Nadella, what they have to say about the environment right now and year to date, how they can continue to capitalize not just on the equity market momentum, but what they're seeing in their own cloud services division. The street is looking for gross margins to come in at 69% for the company as a whole. So we'll be tracking up against that number, and they're expecting revenue of $51.13 billion. And lastly here, I'll end things out with Amazon because that's the other big company we're going to be watching out for next week. Year to date, shares higher by about 27% here, and the street is looking for EPS to come in at about 20 cents a share adjusted there. Revenue, looking for that to hit $124.7 billion. Yes, you heard that correctly, on a quarterly basis. And where does AWS sit within that? I'm glad you asked. AWS is expected to see about $21 billion in revenue over the course of Q1, and we'll see exactly where the guidances shape up, especially as there is more deal scrutiny that all of these companies, especially with their business constituents and clients, have been discussing, Rochelle.
I mean, you have to wonder, going into this season, we knew that there was talk of an earnings recession. You wonder how deep, though, it's going to be when we do finally get some of these heavy hitters in the tech space. What are you going to be watching for?
Well, when we think of an earnings recession, it's, of course, 2 quarters of negative earnings that, or at least declining earnings that we're going to be watching for there. And I think for what these other, what largely the stalwarts of the tech companies and the tech landscape have been discussing is not just on the deal scrutiny front, how and what they're hearing from their own customers and how they're navigating the cost restructuring that they're going through right now, but also where the individual consumer is continuing to place most of their, or the lion's share of their attention. And as of right now, I think for all of these companies, it could be different in the consumer tech side of the business for a company in Amazon and for a company in Microsoft and even Apple versus what they're seeing on their corporate side of the business, where that discretionary spending side on the consumer side has not depleted entirely, but it has decreased significantly on electronics that people are spending on. But at the same time, for corporations who still need access into the data centers, into the web services that these companies provide, that's going to be critically important for them to still be able to hold on to and chart some favorable terms as well, Rochelle.
Indeed. And I'll also be keeping an eye on how much we hear about AI as a lot of the companies now sort of shift and pile into that space as well. Great stuff there. Thank you so much, Brad Smith. All right, well, let's get you a final check of the markets as we head into the noon hour. Off the session lows, but still bouncing around today, all 3 major indices. We see there the Nasdaq just eking out a little bit of positivity there. Not sure it can hang on, though. The Dow there, as we see there, down slightly, though, just about 25 points. The S&P down as well, at least a little bit of green for the Nasdaq. Well, that'll do it for now. I'm Rochelle Akufa, and I'll be back with you at 11 a.m. Eastern. I'll see you then.